As long-time investor Harris Associates sells its remaining stake, we will watch the shares as Europe is set to open mostly higher. China sets a full-year growth target of around 5%, coming in below economist expectations. Metals and crude oil decline. Plus, San Francisco Fed President Mary Daly says U.S. rates are likely to be higher for longer. Chair Jerome Powell heads to Capitol Hill tomorrow.
Tom, a lot going on actually this week. We have U.S. payrolls on Friday. Today, if you look at some of the futures, the FTSE is pretty much flat, but otherwise the DAX getting some 0.1%. We're looking at a lot of data and actually seeing some of the earnings and how they pan out.
Yep, so far, of course, last week, to recap, gains, modest gains across U.S. markets last week, gains across European markets as well. To what extent will that relative resilience to higher rates and higher yields continue? Is it really sustainable as we look ahead to Jay Powell and his testimony on Tuesday? To what extent is he going to push back on the relative optimism that you've seen in these markets, despite that stronger than expected inflation data out of the US and Europe? Of course, hawkish rhetoric from a number of Fed officials and officials at the ECB. The Spanish IBEX currently up 0.4%. Here in the UK, the FTSE 100 down by 6 points, off by about 0.1%. There'll be the China read across, certainly for the FTSE 100. We'll check in on basic resources on the back of that softer than expected growth target coming out of China. The CAC current over in France, up 0.5%, decent, at least in the first few seconds, for France's main equity index. Let's have a look cross-asset then and see how things are playing out as we look ahead to the futures. But first of all, let's stay in China then. The CSI 300, so the benchmark in the world's second largest economy, just down 0.5%. Again, a more modest growth target being set by Chinese officials. And then expectations then in terms of the stimulus coming through from that economy being moderated somewhat. And again, you're seeing that flow through to the likes of commodities, particularly iron ore and oil. Future stateside pointing to very modest gains of 0.1%, again, after the weekly gains that we saw last week. Euro dollar 106 really has been range bound, the single currency, for the last couple of weeks. Just a gain of 0.1%, a little bit of dollar softness coming in, yields coming off across the curve. Brent at $85 a barrel, just down at 0.3%, again, back tying to the China story. Fran.
Tom, if you look at the 20 groups that make up the Stock 600, actually all of them, or most of them, are in the green. Just basic resources are seeing a bit of pressure, and this, of course, on the back of pressure from commodities because the growth target in China is disappointing for most economists. I also have food and beverage now down some 0.3%, but otherwise we're seeing gains across the board, modest gains, but gains nonetheless. The biggest gainer, retailer and consumer goods, up between 0.7 and 1%, Tom.
Yeah, China is, as you say, front and center. The National People's Congress has agreed to set a modest economic growth target, as we mentioned, of around 5% for the year, avoiding any large stimulus to spur a consumer-driven recovery already underway, of course, since the reopening of that economy. Bloomberg's Enda Curran joins us from Hong Kong. Enda, what really stood out to you then from this report by Premier Li Keqiang and how it sets up the policy making in the weeks and months ahead?
I suppose it's a steady as she goes kind of approach, Tom, to trying to manage expectations around China's economy. Like you mentioned, setting that target there of around 5%. Most people expect that to be met given the rebound already underway among consumer confidence and business confidence just because of the end of COVID-0. So they're well on the road to that. Second half of the year might be trickier, of course, when the steam comes out of that rebound. And that's where they have wriggle room to put in some extra spending if they need to. The rest of the targets, the economic targets for the year ahead, were broadly, probably as expected, keeping inflation in and around 3%. That's quite a contrast to the rest of the world, of course. Jobless, urban surveyed jobless rate of around 5.5%. They want to create 12 million new jobs as well, for example. So, all told, it's kind of a careful approach, but there's an element as well of the old team probably had a say in designing this policy program. Let's not forget that there's a new team coming in, and they've, of course, may change things up as they go.
And thank you so much, Enda Kern in Hong Kong with the very latest, of course, on that China growth target. Now, shares in Credit Suisse are trading lower after the Swiss bank's biggest shareholder for many years, Harris Associates, sold its entire stake. Now, Harris Associates Deputy Chair David Harrow shared his view with Bloomberg last year.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it, and that's it.
That was David Harrow of Harris Associates, always very generous with his time with Bloomberg. Joining us now for more, Bloomberg's Jan Patrick Barnett. So, Jan Patrick, if you look at actually what the share price is doing, down 2.2%, it was, I guess, expected, given how badly the stock has been doing, that Harris Associates was at some point going to get out completely.
Yeah, absolutely. And sometimes I feel a little bit sorry for Credit Suisse because they're just like struggle so much to come out from under. But I mean, this is an investor who managed to hold with the bank throughout the financial crisis and is selling its stake now. So that says a lot, I guess, right? And it also speaks to the topic that Credit Suisse has done just very, very little to convince its investors that its turnaround plan is going to work out. The outflows continued in the wealth management business. The management, just like in its tone and wording, and then with the issue of Lehman saying something about the outflows, which now seems to be not 100% true. It's just like there's no signal of confidence from the management, and I totally understand an investor who says like, right, they need to figure this out, and then I'm maybe go back in or not. But for the time being, there's very little to indicate that this is still a good investment.
Well, the Saudis so far have Credit Suisse's back. Does that continue? What other supporters does this bank and can this bank rely on?
Well, it is the Saudis and Qatar, of course, as the two major shareholders there. Beyond that, there's very little at the moment. I guess, like for the Saudis and for Qatar, Credit Suisse is more than just like a pure money investment. It probably plays to their bigger theme of how they spread their money around the world. And I guess for them, it's not bad to have control, or not control, but have a stake in a major European bank and for doing business in Europe and so on and so forth. So it's not all about the money. But right now, I mean, you hear basically nobody like really backing Credit Suisse at this point. This again like says a lot about the state of mind of the bank, that there's no big investor really who is like keen to jump in, even with the cheap valuation.
Okay, Bloomberg's Jan Patrick Barnett, thank you very much indeed on the latest when it comes to Credit Suisse. Let's bring in now our guest for this morning, Christian Müller-Glissman, Managing Director for Portfolio Strategy at Goldman Sachs. Christian, what a day to have you on. There's loads to talk about, whether it's the central banks or indeed the growth target out of China. Let's start with China then, because I know you have calls on this when it comes to commodities, and I know it ties into your views more broadly in terms of the equity space. Your assessment of this lower than expected growth target, is it significant? Do you reassess your views on the impulse for commodities on less stimulus coming through?
Yeah, I mean, it's very clear that it disappointed in terms of levels, but we still have to be, optimistic about the near-term growth momentum. I think this is a story globally in the world where very few places actually have such a reopening impulse. And when you're targeting 5%, that's for the whole year. So there's a very good chance that in the next quarter or two, you will grow well above that. And the challenge is to kind of be invested for that tactically, while from a longer-term perspective, you have a lot of questions with regards to China, not just with regards to the 5% target, but with regards to policy, regulation, the property market. So my sense is, I think the China story from a momentum point of view is probably still going to be very strong near term.
How do you play that, Christian? So when you look at momentum, I mean, at the moment, actually, a lot of economists say maybe it's a little bit disappointing, which has a whole lot of implications in terms of inflation, commodities.
Yeah, I think you make a good point. I think in these type of situations, you always got to ask yourself, do you want to take basis risk, or do you go directly to the trade that actually has exposure? So I think it's probably more the latter. You need to focus at the exact kind of exposure to China. What I found interesting is we found in China-related trades, for example, companies in the US and Europe exposed to China have actually done really well in the last few weeks, as a lot of China-related trades have started to moderate a bit their performance. So it shows you that as long as the actual demand driver behind it is there and the momentum is there, the trades, they can do really well. The problem is a lot of China-related trades, like commodities, as you said, they have other drivers. You also have like the global growth picture, you have like the oil supply, you have like, with regards to China, like maybe shorter-term policy and political concerns. So it feels like the closer you can get to that China services recovery, the better.
And if it is services recovery, then maybe the inflation impulse is less acute coming from China, because that's been the other debate. If you have a ramp up of stimulus, particularly around infrastructure and real estate, it could push inflation globally up again. It doesn't look like that stimulus is coming through. Does that leave us in a less aggressive position, a less dangerous position when it comes to global inflation, and particularly the China impulse?
Yeah, I think our biggest concern was oil, kind of coming into this reopening. A significant increase in the oil price would make the job for the Fed even more difficult. I think we do have now a less clear picture on the inflation normalization, and oil is a very clear driver via gasoline demand of inflation in the US. So the good news is our oil team has, at least for the near term, become a bit more balanced, because you had a lot of supply surprises from Russia, for example. So it means net-net you're dealing with a slightly milder winter, which kind of reduces energy demand, and a bit more supply from Russia. That has meant that oil hasn't been as responsive so far to the reopening, and that's good news. Outside of that, I agree with you. I think the inflation kind of impulses seem to be not as extreme for the global economy. And I think on a kind of like manufacturing side, China has always operated reasonably well throughout the lockdowns. So it's not really that you're seeing any major impact there as well.
Christian, is there an indicator that you look at to tell you the end of the world? I don't know whether we're going to see a massive correction in equities. If we see, for example, the Fed really going for that 2% target, how much will they have to crush the economy, and what are the implications for stocks?
Yeah, the key challenge we see right now is that you've been in this quite bullish sentiment cycle. I mean, at the end of last year, people were probably a bit too bearish on the US economy, a bit too bearish on Europe, a bit too bearish on China. And now you had this major reversal on sentiment, whereas the business cycle and the general macro conditions, they're not going to be that amazing for the next year or so. You don't have that much runway. So I think we'll look a lot at sentiment and positioning right now. The more sentiment and positioning moves up, the more we're worried that you do have a significant setback. So one indicator we track is our risk appetite indicator, which moved up to levels close to 0.7 in the peak. It's now at 0.5, 0.6. If that goes above 1, we found historically you have a bigger risk of a correction if there's a negative shock. I feel like in the last few weeks, you've seen the market moderate a bit, and it's been a bit of a reality check on a lot of the themes with regards to inflation normalization, with regards to growth. So I feel like you have a lot of conflicting forces, and that normally means that you're not, coupled with the sentiment having moderated a bit, that you're not having huge amounts of kind of correction risk. We should be clear, like the Fed going to 2% or focusing on 2% is not really new. We've been talking about that now for like a month, and definitely in the last few weeks, very intense. I think it's more about the data. I think what we would be really worried about is this week we have, of course, inflation data, labor market data. If it confirms that the US is re-accelerating at the wrong time, it would worry us, but I would still say that the Fed is less scary now compared to last year, because it's much less about the speed, it's much more about fine-tuning where you go. And
I love that. The Fed is less scary now than it was last year. Words to live by. Christian, thank you so much. Christian Müller-Gleesman, Managing Director for Portfolio Strategy at Goldman Sachs, of course, stays with us. We'll talk a lot more about central banks. Coming up, Fed officials have stuck with the higher for longer mantra. Mary Daly reiterates support for a peak rate of between 5 and 5.5%. We discuss that next, and this is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Exclusive today, J.P. Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond, live from the J.P. Morgan Global High Yield and Leveraged Finance Conference in Miami, only on Bloomberg TV and radio.
It's clear there is more work to do. In order to put this episode of inflation, high inflation, behind us, further policy tightening, maintained for a longer period, will likely be necessary.
Okay, higher for longer is the message then from San Francisco Fed President Mary Daly, saying more hikes are needed. That, of course, as investors prepare to scrutinize Jay Powell's testimony on Capitol Hill this week. Still with us, Christian Muller-Glisman, Managing Director for Portfolio Strategy at Goldman Sachs. Christian, what do you expect to hear from the Fed chair on Tuesday? What is the message that he needs to communicate to these markets?
Yeah, I think our economists had that view that the hurdle rate is quite high for them to step away from the message they had before some of the hot data we've seen in recent weeks have come in. So a bit more steady as she goes, higher for longer, leaning a bit against the fact that the market has maybe these cuts priced in the second half. But I think the peak rate is now, as it's priced, very similar to what our economists expect. And we just think the hurdle rate for them to now go to 50 basis point hikes is very high. Because to me, that's the market kind of concern. Last year, it was all about how fast the Fed goes. And that's for kind of equities, for risky assets, always a problem. Speed in any type of variable that affects markets, the market doesn't like. So now that you go more towards from how fast to how far you go, that normally is a process equities can deal with. And especially considering that the growth narrative is better now. You actually see PMIs troughing globally. You do see China reopening. So net, it's really the 50 basis points that worries us if there's more of a shift back to that.
But Christian, and I understand the modeling, and I understand what inflation is doing and the fact that there's a lag with monetary policy. It just feels a bit strange, actually, the reactions so far and how quickly the Fed hiked interest rates. Do you worry that if they don't do a lot more, then they're not going to get ahead of inflation?
Yeah, it's very tough to say. I think like the key concern is really the labor market. If the labor market re-accelerates, that's something that has already lagged in the normalization process. I think we've seen significant declines in inflation in goods. There's been a bit of a setback in used car prices recently, but that's something that should solve over time, like market forces will sort that. Services inflation in a lot of places has come down, especially rental inflation, especially some of the high frequency indicators we track. The housing market is slowing. That's all very encouraging, but the labor market has really remained incredibly strong. So if you now see growth re-accelerate too fast, partially because financial conditions have eased quite a bit now, year to date, but also into the end of last year, that would certainly worry us in the sense that the inflation normalization could take longer. That means higher rates for longer, but it could also mean the Fed is worried about achieving their goal, and they might actually hike a bit more.
Christian, to positioning then, you have a neutral view on equities. What turns you more constructive on equities? And going back to that 50 basis point risk, what would that do to that call on equities? Does that take you underweight? So let's start, what gets you more constructive? What goes you from neutral to more positive on equities? And what would 50 basis points do to that view?
Yeah, it's a real challenge right now on asset allocation because you have to balance asymmetry with momentum. Asymmetry is pretty poor. If you look at the cycle, we're late. In a lot of developed markets, unemployment rates are really low, inflation is high, central banks are fighting. And most importantly, risk premia are low. If you look at the equity risk premium, high yield credit spreads, this is a typical late cycle phenomenon. They compress because macro conditions at that time are usually quite good. So the asymmetry to invest, the longer your time horizon is actually worse, whereas the momentum is positive. The momentum has been positive both on the inflation normalization and reaching the end of central bank tightening. And the momentum has been good on growth, with PMIs globally turning, led by China, led by Europe, which had a bit of issues, and also the US is starting to reaccelerate. So you need to put this all together. I think net, that makes us neutral. We want to be a bit more careful on US assets. So we don't necessarily like US equities as much, there's less upside. But I think Europe and China and Asia, there's more opportunities for upside. So net, that makes us neutral. But I agree, it's a challenging thing on your question, what would make us bullish? I think the only way to get more bullish would require the asymmetry to get better. Either the cycle creates a new growth engine, more runway, or risk premia go up. So that would make us more bullish. And in terms of getting more bearish, it's a lot down to the sentiment cycle, as I mentioned. If sentiment now in the next few weeks and months continues to move and stay ahead of the actual data and the narrative, which it has year to date, I think sentiment has been much more bullish than what you can justify with the data. That creates vulnerability. So the risk appetite indicator above 1, that would certainly worry us.
Christian, thank you so much for all of your insight. Christian Miller-Gleesman, Managing Director for Portfolio Strategy at Goldman Sachs. Now, let's get to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Italy's state lender CDP says it's teaming up with Australian infrastructure fund Macquarie on a bid for Telecom Italia's landline network. The offer counters one last month from US investment firm KKR. Both bids are said to value the Italian asset in a range of 18 to 20 billion euros, including debt and some performance-based earnouts. The new CEO of Shell has told the Times newspaper that Britain is less attractive as an investment destination because it is failing to match green energy subsidies, while Sawan says the UK should take a page from some of the things that the US have done recently. He also criticised the shifting tax regime and the government's energy windfall tax. Tesla has cut the prices of its Model S sedan and Model X SUV in the US for a second time this year. Tesla sells its cars directly to consumers and often tweaks its pricing. The latest move comes even though Tesla drastically cut prices in January in a broad bid to boost sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Laura Wright. This is Bloomberg Tom France.
Laura Wright here in London. Thank you. Right, coming up, more on the fallout, of course, at Credit Suisse. One of the bank's biggest backers has sold their entire stake. We'll get the words out eventually. We're going to bring you the details after this. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. it had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Okay, welcome back. Let's check in on some of the corporate stories on the move, of course. Some of the stocks on the move. Credit Suisse, of course, front and center on the news that Harris Associates have completely cut their stake. They've sold their entire stake in the Swiss lender. The stock currently down 2%. They exited, according to David Harrow, over the past 3 to 4 months. And of course, this putting additional pressure on Credit Suisse. The context, they've erased about 95% in terms of value since 2007, the stock. Telecom Italia, slightly different story here. A little bit of good news for this telecoms giant out of Italy. They have managed to line up 2 bids now for the landline network, part of their business, as they try and push down debt levels at the business. State lender Cassa Depositi teaming up with Macquarie Group over in Australia to put forward a bid. That pushes pressure on KKR to come back to the table. KKR pushed through an offer last month. They have been asked to improve that now. The stock rallying 3.6%. And GAM, also in Switzerland, up 2.3%. The Financial Times reporting that the fund manager is trying to find a buyer ahead of results. Those results have been delayed for 2 months. They've also been struggling with asset outflows. Francine, you know the story, Credit Suisse story, very, very well indeed. The importance, the significance of this move then by Harris Associates, is it a surprise? How big a deal is this, do you think?
So we found out actually late last year that he was going from 10% to 5%, so I guess it was only a matter of time. But remember, Harris Associates and David Harrow being the international investor who kind of says, I want this stock instead of this one, you know, he's been sticking with this for about 20 years, and we often and very happily caught up with him to try and get his thinking on the chairman. He's always been involved in Credit Suisse, so it's a little bit of a blow. If you look at Credit Suisse and the story, I mean, there hasn't been good news for that bank for quite some time. It all started with Greensill, and it kind of, it's been a bit of a landslide. As you were saying, the share price lost 95%, and they've been trying to win back clients so far with no success. So it's, I think symbolically, it's a huge deal.
Yeah, absolutely, and it'd be really fascinating to find out what the chairman and CEO, of course you speak to them relatively regularly, would say to this. The Saudis still have that investment. Over at UBS, a very different story in terms of wealth management, but they've been cutting bonus as well. The bonus pool there being cut 10%. There's plenty more coming up, including the auto story over in Europe. This is Bloomberg.
is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Was going to keep rate World Cup. This is a 3.
As the economic picture down.
Okay, so the OK is getting ready to make. Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Pressure continues to mount on Credit Suisse as longtime investor Harris Associates sells its remaining stake. Shares slump at the open. China sets a full-year growth target of around 5%, coming in below economists' expectations. Metals and crude oil decline. Plus, San Francisco Fed President Mary Daly says U.S. rates are likely to be higher for longer. Chair Jay Powell heads to Capitol Hill tomorrow. So, Tom, if you look at the markets, they're looking at China and figuring out what to do next.
Yeah, the message from China to these markets, there will not be a flood of stimulus this year, as they set themselves, as we said, a pretty modest growth target of around 5%. Of course, they set themselves a target of 3% last year and missed it, so they don't want to be missing it again. Across the benchmark here in Europe, you're seeing gains of 0.2% after weekly gains, of course, that closed out on Friday last week. The DAX are currently gaining 0.2%. A slightly different picture here in the UK. The FTSE 100 just down just by 1 point. Basic resources certainly a factor there, tying in to the story around China, the expectation that with less stimulus, there's likely to be less demand for the likes of iron ore and oil. Let's switch it over and see how things are indeed playing out across these sectors. The last time I checked, travel and leisure was near the top. There it is, gaining 0.6%. Consumer products also gaining 0.7%. Energy doing fairly well, a gain of 0.4. You have about, 6 sectors in the red so far this morning at around 8:31 here on this Monday morning here in the UK. Basic resources, bottom of the list, down 1.6%. Again, very firmly tied to the China story. When it comes to the Fed, we're looking out for Jay Powell. That testimony tomorrow, markets pricing in a terminal rate of 5.4%. Francine.
Tom, the EU has delayed a key vote on an affecting ban on combustion engine cars after Germany unexpectedly voiced last-minute objections. Now, Berlin is concerned about how the bloc's green plans will affect the industry. EU and German officials are currently in talks over how to reach a compromise over allowing the use of e-fuels in the new cars after 2035. Now, joining us now is Julia Poliskanova, Senior Director of Vehicles and E-Mobility at Transport and Environment. Julia, thank you so much for joining us. Now, how do you expect this actually to pan out? Is it worth waiting so that we have better technology, or is now the real time to go for it?
Right, so it's just important, first of all, to stress that after over a year of very intense discussions, all the countries, including Germany, European Parliament, Commission, reached a deal to reduce CO2 emissions from new cars by 100%. Concessions there were already made. So actually, we will have again a review in 2026 to see if it's possible. And there are already provisions for the Commission to allow the use of so-called e-fuels or synthetic petrol on diesel to be used in new cars. So all is already available and acceptable in that law. There are no blockages, in fact, for e-fuels. It's just a matter of work in progress to put this together. Germany supported this very same agreement back in November. So what's happening now it's delayed. But it's not delayed because there's something wrong with the law. It's delayed that simply because it's internal point scoring, political point scoring by the German liberals in the government in Germany.
Okay, Julia, is it point scoring or is it a reality that in terms of the supply chains, in terms of access to the likes of nickel and cobalt, Europe has a long way to go in terms of the reality as to what it means for the crushing blow to jobs across the auto sector? That is a reality, is it not, that the Germans and the FDP are flagging here?
The reality is that we're in a global race to batteries, electric vehicles, and renewables. This is the future. Europe actually has had a lead. Our analysis showed that from all the factories, battery factories announced so far, Europe would be able to source all of its batteries here domestically in Europe. So we already sell over 2 million of battery electric vehicles across the bloc. If we compare that to e-fuels, which is the solution or the alternative that the likes of the German liberals are proposing, there is any commercial production of those fuels. They're scarce, they're not available, they're less environmentally friendly, and most important, they're more expensive than battery electric vehicles. It would cost you 10,000 euros more to run a petrol car on synthetic petrol, if you can even get it, in 2030 than to run a battery electric vehicle. So we are accelerating the battery value chain. This is the game, and at the same time, it's dangerous, a dangerous distraction to be going for synthetic fuels.
So, Julia, I think Elon Musk was saying a couple of days ago that his next battery and some of his next Tesla cars will be able to use, well, to function without rare earths. Do you think this is the future, and what does that mean for our codependency on China?
Yes, absolutely. So electric motors without rare earths were already possible. In fact, Tesla used to make those motors before. Renault is also having electric motors without rare earths. So that's important. It's an important innovation. Quite importantly, when we talk about raw materials, there's so much innovation we can do. Today, we have lithium-ion batteries, but we're already going for so-called nickel and cobalt-free chemistries. So lithium iron phosphate or LFP batteries are becoming popular. Soon we might have natrium batteries, sodium batteries, things without lithium. Innovation is critical when you have scarce raw materials. And on top of that, Europe, just like America, is about to propose its own Critical Raw Materials Act to actually get ourselves faster in securing processing and refining of these critical metals, as well as having global and internal efforts to secure raw materials. Just to add one last thing, lithium. On lithium, our analysis shows that we have lots of resources in Europe. Over half of all the lithium Europe might need in 2030 can actually come from domestically sustainably produced resources. For example, direct lithium extraction projects such as Vulcan in Germany. So things are possible, but we need strong industrial policy and strong regulations that create that investment certainty for things to happen.
Julia, just briefly on the policy then, can they get this through? How much of a threat is that target? Is that target of 2035 in terms of removing ICE combustion, internal combustion engines, is that target a threat now, or do you expect them to get it through as you sit there in Brussels?
So I hope that eventually there will be an agreement between the European Commission and Germany for this vote to go ahead. For now, it's delayed because without Germany supporting this law, with Italy, Bulgaria, and Poland also against, there is no majority. So unless German government or the self-proclaimed climate Chancellor Scholz actually acknowledges that he already supported this law and make sure that his credibility is on the line, so he actually supports this agreement. Unless this happens, the law cannot be passed.
Okay. Julia Poloskanova, thank you very much indeed. Senior Director of Vehicles and E-Mobility at Transport and Environment. Thank you for the analysis on that as we continue to watch this story. Now, shares in Credit Suisse are trading lower after the Swiss bank's biggest shareholder for many years, Harris Associates, sold its entire stake. It is piling more pressure, of course, on the lender's leadership. Joining us now for more is Bloomberg's finance reporter, Marion Halftermeyer. Marion, investors clearly not happy this morning. How much of a shock, how bad is this for Credit Suisse?
This is pretty bad, but this isn't entirely a shock. Harris Associates had reduced their stake on the back of the capital raise last year. So we saw their stake come down from being the largest shareholder around 10% to 5%, and now they've fully sold out. So it's not a great look for the bank, which is really needing the support of its shareholders as it's going through this very intense restructuring period.
Do they have, I mean, we do have, and good morning, Marion, we do have a lot of, well, not a lot, but a couple of big players in the Middle East that want to support Credit Suisse. Are there any other supporters?
So as you're right, Francine, so there are a few main shareholders who are supporting the bank. So we saw the Saudi National Bank take that 10% or almost 10% stakeholding in Credit Suisse. They've been supportive. QIA, Qatar Investment Authority, has also been there for a while, and they've taken up more stake as well. After that, the shareholdings gets much more small. On the other hand, they have had a lot of interest in the carve-out of the investment bank, the CS First Boston, which is actually the reason why Harris sold out. So there's differing views among the shareholders as to whether this plan will work and whether spinning out an investment bank is going to be helpful for the bank to return to profitability.
Marion, as always, thank you so much for joining us. Bloomberg Finance Report, of course, covers Credit Suisse very closely. Marion Hoftefmeyer. Now, coming up, President Biden closes in on an executive order to restrict U.S. investment in China. We'll discuss that next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing when we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
News breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
The work report, is basically we're back in business. We're going to restart the economy. We're still engaged with the world.
Expectations are playing a key role here. I think, they were burned last year by, really missing their 5.5% target. And so what I think they're going to do this year is aim low and then try and surprise on the upside.
If anything, given the focus on economic growth agenda, there's potentially actually more upside surprise on the policy side. There's a lot of room for them to do more.
Bloomberg TV guests there talking about China's economy growth target and, of course, possible policy upside a day after the National Party Congress started in Beijing over the weekend. Now, the Biden administration is also said to be nearing completion of an executive order restricting investments by U.S. company in parts of the Chinese economy. Now, for more, let's bring in Bloomberg's Bill Ferries in Singapore. So, Bill, what do we know at this point in terms of details, and is this for national security?
Well, we're still waiting to get a lot of those details, and we're hopeful that when the president releases his proposed budget later this week, that there'll be some more specifics in there. But what we believe is that it would basically allow the U.S. to restrict investments in key technology and key industries, things like artificial intelligence, quantum computing, semiconductor manufacturing. There have been already U.S. limits on the ability of companies to export certain technology to China. This takes it an extra step and would basically ban investment by companies into Chinese companies that are in certain sensitive industries.
Yeah, and presumably it adds grist to the mill for those in Beijing who, again, over the weekend on Sunday, kind of pushed this message of self-reliance again in terms of a key priority. When it comes to the relationship then, Bill, between Washington and Beijing, President Biden again reiterating that he would be available. He's open to talking to Xi Jinping, his counterpart, at some point soon. Is there any sense at all that they can get any kind of reset in terms of relations?
Well, it's a really interesting question at this point because both leaders have to deal with dynamics in their domestic politics that are, going in a different direction, even if they, as the two leaders, can reach some sort of accord. Certainly, I think both sides would say it's better to be open to talks and to have talks taking place. But what you see with other measures coming out of the U.S. Congress, for instance, in terms of potentially banning things like TikTok, ramping up military support for Taiwan, and other issues, is that the dynamics, the stresses in the relationship are becoming much more than whether the two leaders are talking to each other or not at this point.
Okay, Bill Ferries, thank you very much indeed on these plans, proposals being worked up in Washington to further restrict investment, of course, in certain sectors in China and the prospects of a potential meeting between the two presidents. Let's get more in terms of the first word news now with Laura Wright. Laura.
Thanks, Tom. Estonia's Prime Minister Kaja Kallas has secured a commanding election victory, fending off a challenge from the far right. Her Reform Party took around 31.5% of votes, with counting almost complete. Under Kallas, Estonia has been one of the most strident critics of Moscow, supplying Kyiv with more weapons than any other country on a per capita basis. UN negotiators have agreed the wording of a new international treaty that adds protections for almost 2/3 of the global ocean. The agreement is a culmination of almost 2 decades of work and seeks to end the unregulated exploitation of the high seas. If delegates formally adopt the text, it will go to the UN General Assembly for approval. SoftBank-backed UK chip designer Arm is reportedly seeking to raise at least $8 billion at a US IPO. Reuters says Arm is connected to confidentially submit paperwork for its listing in late April. Bloomberg earlier reported that bankers had pitched a wide valuation window of between $30 and $70 billion for the company. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Laura Wright. This is Bloomberg Tom Francine.
Laura, thank you so much. Laura Wright in London. Now, shares in Telecom Italia are surging after the Italian state lender, GDP, said it was teaming up with Australian infrastructure fund Macquarie on a bid for the network. Well, the move sets up a multi-billion-euro takeover battle with U.S. investment firm KKR. Joining us now is Bloomberg's Milan Bureau Chief, Tommaso Ebhard. Tommaso, good morning. So who will actually come out on top of this bidding war?
Sì, buongiorno Francine. It's finally true. After months of discussion, the Italian state lender made its bid with the Australian fund Macquarie for Telecom Italia's network, starting a bidding war with KKR. The two tried to come with a single bid, but they couldn't agree. So at the end, the Italian state lender went solo with Macquarie. The value of the assets about 20 billion, including the debt. Why there is so much interest for the network? Because it's a very precious asset that are arriving €1 billion of EU funds to invest in Italy ultra broadband network, and so it generates stable returns. Why Telecom Italia has to sell its most precious asset? Just because it has over 30 billion in gross debt, market values of about 7 billion euros. In 2005, Telecom Italia was worth over 50 billion euros. This shows how it went down, the former Italian monopolist.
Okay, Bloomberg's Tommaso Eppard on that bidding war then for Telecom Italia, and as you say, the golden part of its business really in terms of the landline network. That stock currently gaining 3.2%. Coming up, banks grapple with life after Brexit. We'll look at how lenders are beefing up their operations, not here in London, but in Paris, as City plans a new trading floor in the French capital. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Fabio Lisanti just moved from London to Paris a few days ago.
How are you?
Good, you? Citigroup is planning to double its staff in Paris, building a brand new second trading floor.
Traded sales structures, you have a whole ecosystem of markets people moving to Paris. And when you look at it as an opportunity for staff like myself to move, Paris is a lovely city.
Banks are looking at Paris as a pool for talent, with experienced traders who create complex derivatives at Société Générale, Natixis, or BNP Paribas.
There's enormous amount of talent locally, and there's some very strong domestic players which have grown this talent.
JP Morgan, Goldman Sachs, Morgan Stanley, and Bank of America have all beefed up operations here. France is now also home to the largest European stock exchange by market cap.
London used to be the largest financial center of the European Union, and everybody liked it. Today, London is the largest financial center of the United Kingdom.
The Euronext CEO says the trend could become more acute in the long term, as fewer young Europeans come to study in London, even though the number of relocations from London remains below the 10,000 expected at the time of Brexit.
Okay, Bloomberg's Caroline Gunnar there on banks ramping up their operations in Paris following Brexit.
The newsroom is on fire, could I just say, on this package.
Do you have strong views on this?
Everybody has strong views on this. We love Paris. A lot of bankers, many bankers actually that I know, drag their heels to go to Paris.
Why?
London is
Why
London.
the reluctance?
Because London is London.
And also they have the world's smallest table tennis table. Did you notice that?
I was thinking
Tiny.
we could get
What
one
is that
for
about?
our newsroom.
Let's bring in Jenny. Yeah, let's lobby for that. Jenny, who's going to give us the details on this. Listen, in terms of that pull then to Paris City, is it a one-off, or are you seeing a surge of banks moving over there? How sustained is this likely to be? How damaging is it for London?
I don't think it's a winner-takes-all game. So we're definitely seeing a sustained move towards Paris, especially for folks in the trading divisions at these banks. Brexit just means that they have to have more of these folks with risk books trading these assets on the continent. So we're definitely seeing that, but I don't think it's by any means that London is, no longer a financial hub or completely losing out. We're still seeing a lot of growth here too. So there's no winner takes all here, but Paris is definitely getting a boost.
So, Jenny, out of all the kind of the financial capitals that could have been, right? We have Milan, we have Madrid, we have Frankfurt. Is Paris seems to come up trumps actually compared to them, because we have JP Morgan, we have others. What's the attraction to the city?
Yeah, we asked that a lot when we were doing our interviews for this story, and I think the local players in Paris really helped kind of going into this. So they had already been trading really complex products. The regulators were familiar with regulating a complex bank, so I think that was really what set a lot of these banks over the edge on trading divisions being in Paris. But you are still really seeing a lot of growth in Frankfurt, Dublin, Milan, to your point. So I think different cities will win with different types of bankers and traders. But yeah, Paris seems to be the big pick for trading.
And President Macron, of course, will be cheering this on. He's been out front in trying to court those bankers from London. He's been very open about this. What about the response then from Westminster, the response from London, the response from the city?
Yeah, I mean, I think it's hard because there's these regulations really pressuring these banks. So there's nothing they can really do. They have to move these folks. But I do think they're still doing a lot of investment here. I think you guys had David Livingstone on from Citi just last week, where he said we're still a big believer in London. They're revamping their Canary Wharf offices. So I think there's a way for both places to win, but definitely Paris getting a boost in the meantime.
I remember a couple of years ago, so you speak to big chief executives, and they say, the problem is convincing my staff to move anywhere else than London because of the schooling system, because of the infrastructure, because actually English is also not their first language. So it's difficult if you have like a British family or an English-speaking family. Has Paris gotten better at things like this? And numbers remain quite small, right, Jenny?
Numbers remain quite small. That's a really good point, and definitely good context. But I do think it's gotten better. As we were talking to folks, they said it's a place that people want to come to now. And the fact that it's only 2 hours away on the Eurostar, even better.
Emily in Paris, this is what people go for. They move to Paris,
that's
living the high life.
That's been the pull factor?
Probably,
yeah.
At the margins.
Yeah, they can thank Netflix.
Jenny, thank you so much. Our finance reporter, Jenny Certain.
Okay, let's briefly check in on one of the big corporate stories, of course, of the moment. Again, this is a story that Francine, of course, knows very well as well. Credit Suisse currently just down 0.4%, pairing some of the heavier losses, of course, on the back of the news that Harris Associates have sold their entire stake. Harris Associates telling Bloomberg that they exited Francine over the past 3 to 4 months.
Yeah, and this is a big deal. So the share price is not moving that much, I think, because it's lost so much in the last 4 to 5 months. We knew also that David Harrow was exiting, I think, from 10% to about 5%. But actually, symbolically, this is a huge deal.
Yeah, absolutely. We'll have to see what the response is from Credit Suisse going forward as they try to address those outflows. Plenty more coming up, of course. The chairman of NatWest, Howard Davis, will be speaking to Francine 9 a.m. UK time. Stay with us for that. That is it for the European market open. Surveillance early edition is up next. Your European equities currently up 0.3%, futures gaining in the US. This is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance, early edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Shares fall in Credit Suisse after longtime investor Harris Associates sells its remaining stake, piling more pressure on the troubled Swiss lender. China sets a full-year growth target of around 5%, coming in below economists' expectations. Metals and crude oil decline. Plus, has London actually lost its appeal as a top destination for investment? We'll discuss that in our exclusive interview with the chairman of NatWest, Sir Howard Davies. Now, first thing is first, let's check in on the markets. A couple of things that we need to look out for. First of all, global markets pretty much steady when it comes to stocks. I think the big question is what happens to Treasury yields. Would they extend the decline that we saw last week? And of course, as we continue looking at National People's Congress over in China, we'll have more clues on what kind of growth they're expecting. I know we're seeing quite a lot of pressure on commodities on the back of that 5% growth target, which was a touch below what economists were expecting. European stocks for the moment gaining 0.3%. S&P futures practically unchanged, and then a bit of pressure because of that expectation of China growth for crude oil down 0.7%. Now let's also look. We are bracing for a lot of course, strikes in France over the week. So let's also see if there's a difference between what the UK is doing. There was a pretty explosive interview in the FT from the Shell chief executive saying, look, the UK needs to do much more to become as investable as the US. A bit of pressure on the FTSE 100 there, down 0.1%, the CAC 40, but also the FTSE MIB gaining some 0.6%. Now, shares in Credit Suisse are trading lower after the Swiss bank's biggest shareholder for many years, Harris Associates, sold its entire stake. Harris Associates Deputy Chairman David Harrow shared his view with Bloomberg last year.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it and that's it.
Well, joining us for more is Bloomberg's finance reporter, Marion Halftermeyer, who is on top, of course, Credit Suisse and breaks more news than anyone else. Investors, Marion, good morning, are definitely not happy.
No, they're not happy. And as you saw in that clip, actually, you know, David Harrow of Harris Associates had actually been a longtime supporter of Credit Suisse. And we saw that support start to erode over the last couple of years as the bank was just hit with scandal after scandal and was losing a lot of money. And that was a great interview, Francine, from last August, where David Harrow was saying, they need to really fix this money-losing investment bank. Now, the ironic part is that they did actually do what some of the things he was calling for. They've decided to spin out that investment bank. But it seems to be that it's just not going to be enough, and maybe it's a little too late and too costly at this point, so they've given up.
So what supporters do they have left?
So they've got the Saudi National Bank. They came in as a new big supporter. They've almost got a 10% stake now. They came in with the capital raise last year. And then they also still have the QIA, which have been longtime supporters since the financial crisis.
What does it mean for, what does the bank need to do at this point to actually reset its business? And Marion, if you think about it, without going into philosophy, it's really difficult for the bank to attract new shareholders if everyone else is doing better because of higher interest rates.
It is a difficult spot. It's a difficult year to be doing a turnaround. And the whole situation is complicated further by the fact that they have not only this complicated carve out of an investment bank, which has rarely been done in history before, not at this size and scale. And then also on the flip side, they're trying to keep their wealth business healthy and profitable. And that's been really difficult as we've seen just massive outflows on that side of the business. So it's really hard to get investors interested in Credit Suisse turnaround story right now, particularly because they're not going to be profitable for another year or two from now.
Marion, thank you so much, as always, for your great reporting. Bloomberg's finance reporter covering, of course, Credit Suisse from Zurich, Marion Hofdefmeyer. Now, China's National People's Congress has agreed also to set a modest economic growth target of around 5% for the year, avoiding any large stimulus to spur consumer-driven recovery already underway. Let's bring in our Chief Asia Economics Correspondent, Enda Curran. Enda, good morning. So what exactly is the significance of this policy?
Well, it suggests a fairly modest tone on the stimulus front for China. Francine, like you mentioned, the targets come in at around 5%. Some economists were talking about 5.5%. They're also talking about creating 12 million urban jobs this year, keeping the unemployment rate, the surveyed jobless rate, at around 5.5%. So it's kind of a broad message of steady as she goes for the economy, certainly hosing down any expectations for massive kind of stimulus that we've seen in previous China downturns. The expectation is the target will be hit well because the consumer spirits and business sentiment has improved with the end of COVID-0. The second half of the year might be more difficult, however, and that's where the government support will kick in. But more broadly beyond that, the MPC is also going to be critical to see what personnel get what jobs, and of course that will play a role in shaping the narrative for China's economy in the years ahead.
So, Enda, what has been the messaging actually on technology from China's NPC?
Well, we had, through the state media today, we had messaging from President Xi Jinping making the point that China is going to double down on high-end manufacturing. This is all about cutting China's reliance on the US and elsewhere for the kind of technology it needs to turn itself into a tech kind of superpower. So there's no hint of a U-turn on that. And of course, it puts itself on a collision course with the US at a time when the US is forcing through export controls and other restrictions. So that messaging on developing its own technology will surely add to the ongoing tensions with the US.
Enda, thank you so much. Enda Curran there, of course, on the very latest on China. Now let's get straight to the Bloomberg First Word News. Here's Samuel Etienne. Hi, Etienne.
Good morning, Francine. Bloomberg has learned the White House is close to completing an executive order that would limit some investments by US companies in China. The restrictions are said to include advanced technologies that could enhance China's military and intelligence capabilities. UN negotiators have agreed the wording for a new international treaty that adds protections for almost 2/3 of the global ocean. The agreement is a culmination of almost 2 decades of work and seeks to end the unregulated exploitation of the high seas. If delegates formally adopt the text, it will go to the UN General Assembly for approval. And Estonia's Prime Minister Kaja Kallas has secured a commanding election victory, fending off a challenge from the far right. Her Reform Party took around 31.5% of the votes, with counting almost complete. Under Kallas, Estonia has been one of the most strident critics of Moscow, supplying Kyiv with more weapons than any other country on a per capita basis. And the new CEO of Shell has told the Times newspaper that Britain is less attractive as an investment destination because it's failing to match green energy subsidies. Well, Sawan says the UK should take a page from some of the things that the US have done recently. He also criticized the shifting tax regime and the government's energy windfall tax. That's Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Thank you so much, Samuel Etienne here in London. Now, coming up, as global markets react to China's 5% economic growth target, we speak to Sir Howard Davies, the NatWest chairman. That exclusive conversation is up next, and this is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority. Today, J.P. Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond, live from the J.P. Morgan Global High Yield and Leveraged Finance Conference in Miami, only on Bloomberg TV and radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's return to one of our top stories this hour. China has set a modest economic growth target of around 5% for the year. It suggests less of a boost to the already struggling world economy. Well, joining us now for an exclusive conversation is the NatWest chairman. He is Sir Howard Davies. Sir Howard, thank you for joining us. We'll talk about banking. We'll talk about the UK economy. But first of all, over the weekend, we were really trying to follow what was going on in China. A lot of economists saying, look, 5% is just not strong enough. From a UK perspective, how much does the UK need a strong Chinese economy?
We benefit somewhat indirectly from China because, unfortunately, the UK does not export anything like as much to China as, say, the Germans do. So in Germany, it's big news because of the exports of cars and heavy equipment. For us, it's more indirect because our actual direct trade volumes are relatively modest. So it's not great news, but I don't think we'd been expecting much more, frankly. And 5% that's actually delivered would be better than a sort of bogus 8.
Yeah, which they can't deliver on.
That's right.
Talk to me, if you look at the pitfalls for, the inflation, I mean, you're one of our smartest thinkers on everything from banking to inflation to how central banks, deal with it. Are you confident about the world economy?
I'm confident that the economy is a bit better than we thought. I mean, we've said for a while that we thought the UK economy would be broadly flat this year rather than the recession that the Bank of England was forecasting. And so far, touch wood, we're looking as though we probably were right about that. But I'm quite pessimistic on inflation. I think that inflation has become, in this economy, somewhat more embedded than we wanted. And inflation expectations are now higher. And I think it's going to be very hard to get inflation back down close to the Bank of England's target.
So do you think the Bank of England will have to be very, very aggressive in trying to regain control? Are we close to seeing actually a wage spiral? Or do you think they'll leave it at 3-4% without worrying about it too much?
I fear they're going to have to do more than they are currently saying. But the big question, and you can see people starting to discuss this, a very interesting article by Andy Haldane, who was the chief economist in the Financial Times over the weekend, as to whether really getting down to 2% next year is actually feasible, or we should think about saying, well, we're not going to try to get there in one go. We're going to maybe get to 3 or 4% and then look at it again. That personally would be my favoured route, because I think if they really do try to get to 2 next year, then it's going to be unpleasant.
I mean, unpleasant as in that they'd have to crush the economy.
I think they would have to raise rates quite a bit, and in order to get down to that, you've got to change expectations, and changing expectations is tough once you've allowed them to become unanchored. And so I think the output cost of getting there would be high.
I think 4 or 5 months ago, we were talking about, zombie companies and the fact that it's amazing how fast the Bank of England was able to raise interest rates without many companies going bust. Are you still uneasy? Like, I know there's a lag time of how the monetary policy works, but are you uneasy about nothing ugly having happened?
Well, that hasn't changed, and we keep expecting that there'll be more bad debts in the corporate sector, but we aren't seeing them yet. And it does seem that companies did build up deposits through the COVID period. They are running them down, but slowly. And so there is quite a cushion still there for companies. So no, we're not yet seeing the kind of wave of bad debts that we thought we might see. And I think that's true of the other UK banks.
But could they never come? Or at some point, is it going to be, reckoning time?
I think in some sectors they probably will come, because you probably have got preserved some companies whose business models are no longer appropriate for the new world, and they were sort of set in aspic pre-COVID. But at the moment, I have to say, we're not particularly pessimistic about the UK corporate sector at this point.
So Howard, talking about mortgages, again, I know there's a big wall of mortgages, up for refinancing, I think, middle of next year. Do you worry about some of the stress?
Well, it's not enormously, because we used to stress our mortgages at 7%. So in other words, if you came for a mortgage with us when fixed rates were 1.5 or 2%, we would say, okay, well, Francine, can you cope if interest rates are 7? And we'd go through your finances with you and see if you were okay at that. So we're not expecting, since we haven't got above to there, we're only about 4% at the moment, we're not expecting a lot of people to be in absolute distress unless unemployment rises, because that is the key thing. If unemployment stays relatively low, employment rates stay relatively high, then we're not so fussed about it. People won't like it, because of course they'll have less money to spend on other things, and that won't be great for the economy, but we don't expect a lot of mortgage defaults.
But the 7% stress test, does also factor in, inflation at 10% for energy and other goods?
Well, I mean, the honest answer to that is no, it didn't. So people's finances will be a bit more stressed than it looked as though it was. But there's quite a gap there. So I'm not expecting big defaults. As I say, people will find their disposable income squeezed, and they're going to find that squeezed through inflation. But that's a different thing.
All right, Sir Howard, stay there, because I know we have, I have many, many questions to ask you about France versus London, or Paris versus London, and of course how investable the UK is. We're back with Sir Howard Davies, NatWest Chair, very shortly. Coming up, we'll talk about the UK, discuss the City of London's investment appeal in a post-Brexit world. More on that next, and this is Bloomberg.
Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now let's continue our exclusive conversation with the NatWest chair, Sir Howard Davies. Sir Howard, thank you so much, first of all, for staying with us. When you look at a lot of bankers, and this was, I think the latest was Citigroup, a lot of bankers having to move to Paris. I remember you explaining also with data about how some of the high-earning banks and bankers had to move because of Brexit. What does a Windsor framework mean now for bank moves?
I don't think that will make much difference at all, actually, because the key thing is what the European Union does on things like euro clearing, and that's in their hands, not in ours. They're finding it very difficult to persuade people to shift their euro clearing into the Eurozone because London is more efficient and a deeper, more liquid market. But I doubt if the Edinburgh reforms will make any difference to those moves. But they're not on a massive scale, I have to say, so far. I mean, if you look at the numbers, you see the big winners have been Dublin and Luxembourg, and to some extent Paris. We've increased our numbers in Paris, but to some extent by consolidating from elsewhere in Europe, actually.
Is the UK investable? So we've had a couple of chief executives speaking to various press saying, look, in terms of green technology, the UK should be more like the US. Other chief executives say they should be more like the EU. Where are we on investability of the UK right now?
Well, I mean, I guess you have to look sector by sector. As far as the energy sector is concerned, I think we do have to listen carefully to what people like Shell are saying, because, you know, that's their perception. I couldn't really countermand that, if you like, from a banking perspective. As far as finance is concerned, then I think that London used to be the onshore financial centre of Europe, really, as well as the offshore financial centre. And now I think we're becoming the offshore financial centre of Europe. So European companies looking to raise funds in the Far East and in the US, etc., London is still the centre, but we're no longer well positioned to intermediate intra-European flows. I think that's the shift that's going on.
Is there anything that the UK can do in terms of regulation to attract more of these IPOs? I think they lost out twice last week.
To IPOs, yeah, is a different matter. I mean, I think that's more to do with investment demand in the UK. And what we've seen is a long period during which the UK institutions have reduced their holdings of UK equities. Now, I think we might hope, and here one of the reforms is relevant. I think the Solvency II reforms should make long-term institutions here should give them a higher appetite for UK equities in the long run. So that could be helpful. But unfortunately, you know, New York did win on technology stocks. And so any technology stock, I think, finds a more ready home in New York with analysts and investors more willing, more understanding of their business model. And so there has been a bit of a bifurcation, and that's not helped us because it's been tech stocks that have been growing more rapidly.
But has that changed? And actually, is there a danger that this also hits other sectors, that, you know, gradually London is just seen as less of a good place to be IPO'd or listed in?
Well, it could do, and I think we need to try hard to stop that. And I think the reforms proposed by Jonathan Hill, I'm not sure this has anything to do with the Edinburgh reforms exactly, but Jonathan Hill did a very good report about the ways in which London could be made a more interesting market for IPOs, and I think those are worth pursuing.
Is there anything that you would do more immediately, actually?
I'm not sure that you can turn this tap on with just a single regulatory reform, frankly. I mean, some of the reforms on two-tier stocks and things like that and voting rights are probably worth doing at the margin, and so they would make some kind of difference. But I feel we're talking very long-term trends here.
Is there something that the Chancellor can do more immediately in the budget to, you know, if not have a huge impact, at least be perceived as more investor-friendly?
Yes, I think the big problem the Chancellor has got is that with the changes in corporation tax, which has been a bit of a push-me-pull-you thing, with, you know, rates supposedly going down, then going back up, and investment allowances going up and then going down, I think he probably does need to tweak that, because otherwise I think it is going to look as if the UK is running against the rest of the world, and the UK is not very attractive from a corporation tax point of view. Now, he hasn't got as much room for manoeuvre as some people are suggesting, given the medium-term fiscal prospects, but I think something on investment allowances would be sensible.
Sir Howard, thank you so much, as always, for giving us a little bit of your busy schedule. That was Sir Howard Davies, the NatWest chairman. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. Also coming up, the former Treasury Secretary, Larry Summers, says the Fed is behind the curve again. We'll speak to Greg Peters of PGIM, fixed income on Fed, China, and his outlook. And then we have to talk coffee with Andrea Illy. We'll talk about a possible IPO, and we'll talk, of course, about the price of Arabica beans. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Shares fall in Credit Suisse after longtime investor Harris Associates sells its remaining stake piling more pressure on the troubled Swiss lender. Well, China sets a full-year growth target of around 5%, coming in below economists' expectations. Metals and crude oil decline, plus San Francisco Fed President Mary Daly says U.S. rates are likely to be higher for longer. The chair, Jay Powell, heads to Capitol Hill on Tuesday. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Fed Chair Jay Powell set to deliver his two-day biannual monetary policy testimony on Capitol Hill tomorrow. He's expected to echo fellow central bankers in suggesting that interest rates will go higher than anticipated. Well, the former Treasury Secretary Larry Summers says that the Fed is behind the curve again. He spoke with Bloomberg's David Weston.
The Fed right now should have the door wide open to a 50 basis point move in March. No need to be committed to that till we see the next employment figures, till one sees what happens in markets. But if markets are now saying 22%, that means the door isn't open to that possibility. And there's a very significant chance that that's going to be the right thing to do.
Well, joining us now is Greg Peters. He's Managing Director and Co-Chief Investment Officer of PGIM at Fixed Income. So, Greg, thank you so much for joining us. It does seem, if you look at actually fixed income and some of the wild swings that we saw in treasuries and just in general yields, including high yield, like what's the new regime looking like for fixed income?
Well, I think fixed income is just following the data like the Fed. So everyone's proclaiming the Fed should do this, they should do 25, they should do 50, but we're all just beholden to the data releases, and fixed income is just following along. What I think is interesting, though, is that the fixed income market continues to be very inverted from a yield curve perspective. So you have this higher for longer in the front end, and then you have this, pricing in a recession, at least, to a certain degree in the back end. And at the same time, you've had a very solid backdrop for risk assets. And so those two things really don't comport.
But Greg, the market is basically trying to figure out what the Fed does, but we need to figure out what inflation does. How do you expect inflation to behave in the next 6 to 7 months?
So I think the lesson learned and relearned over the past 2 years is that inflation is really difficult to forecast, right? So the forecast error around that function is extremely high. At the same time, we do think it's coming down, but the real question is, where does it land? So you're saying, the wage pressure side is the key because it's hard to get service inflation lower when wages are so strong and the labor market's so strong. So that's really the key. So it's almost more about labor than it is inflation.
But how's it possible? And I understand that monetary policy has a laggard, maybe to 12 to 18 months, that, a former policy member reminded this of us last week. But how's it possible that employment is still so strong, given how much we've hiked?
It is befuddling to many, and I don't think anyone really forecasted such a high level of rates with such a strong kind of labor resiliency. At the same time, though, a lot of the areas of the labor market are just recovering from pre-pandemic. So if you look at some of the service areas around hospitality, that's still below where it was. So it's a very interesting labor market for sure, but at some point, we don't know what the level is, but at some point, we're pretty certain that higher rates will lead to a weaker employment market.
Greg, do you know when that is? And again, we're talking about the consumer, continuing to spend. How much of this is a legacy of COVID, of savings that they had put in place that they're now burning through?
So I think what's been missed is the strength in the nominal growth, right? So everyone's been focused on real GDP, But when you're coming off of very high nominal growth, which is where we're coming off of, it's still reasonably high. That means there's an underlying strength, underlying spending, and I think it just takes longer for that to shake out of the system. So the Fed, I believe, central banks globally will hike until something breaks, and we're just not there yet.
How much imagination do you think central banks and the Fed especially will have? So will they stick to the 2% targets? Will they, live with inflation of the 3 to 4% because otherwise they'll have to crush the economy? Or will they just, delay the communication when they'll touch 2%?
Well, I'm hoping they're not overly dogmatic, but I think 3.5 to 4 is too high.
Yeah.
I think in the 2% area is actually okay, but it's an open question. Everything's an open question, right? But I think the worry is that once you lose control around inflation, it's hard to get it back, and the Fed knows this, and they're a student of history, and they don't want to be on the wrong side of history here.
So 2023, how much volatility in bonds? I mean, I feel like this is the year of fixed income to, the good or the bad side.
No, I still think it's the year of fixed income. So I do think bonds are back, yields are higher, often negative, zero rates. These are all very positive items for sure, but there's still a lot of work to do, and volatility will be here for a while, but we're coming off of a much higher yield level, so it covers a lot more mistakes.
So Greg, what are you buying right now? If you look at your ideal portfolio, let's say 2 months from now, and then longer term to the end of the year, is it different?
It is. So I think it's too early to go deep in risk, deep cyclical type of investments. We see a lot of value in structured products. We see a lot of value actually in the front end. You're getting a lot of carry. So we think it's a market to take what's given to you, and there's a lot being given. And so it's not a place to go into triple C's, levered loans, all these types of areas. It's a much safer environment for bonds, and we're just taking the carry and roll.
I don't know how you look at the inverted yield curve. I have at least 1 or 2 viewers every day that send me a good chart on this. Like, what do you think it shows us?
Well, what it shows me is that something needs to be reconciled this year, and I think that's the source of volatility. You can't have an inverted yield curve and expect risk assets to do well. So what I worry about in terms of 2023 is actually we achieve this soft landing and the curve starts to normalize, and that's the catalyst for the slowdown, because there's so much borrowing off the intermediate to back end of the curve that could actually be the hit to consumers, that could be the hit to corporations ultimately. So it bears watching, no pun intended.
It certainly does bear watching. Greg, I mean, so we had the new China data, or certainly growth forecast, which some economists say, look, it's disappointing, but I guess there's a better chance of them actually hitting it. Does that change your strategy, or at least your thinking longer term of how much China can contribute to the U.S. economy?
Well, so I think what's being missed here is the secular shift. The past 10, 15, 20 years where China was the driver of global growth, that is no longer the case. And so I think what you'll see during this whole economic maturation process of China is just less and less growth into the global system, and that matters a lot. So I don't think we're going to have the same kind of fueling of China into the global system, and this is just a reflection of that reality. So 5 years forward, 10 years forward, it's just going to be less and less and less, and that matters globally.
But they've also been talking about creating a parallel system, right? So this affects how much treasuries they buy, but also I don't know whether there's petro yuan that we need to worry about, or China's reserve currency like renminbi.
Well, so I think you're bringing into this whole geopolitical aspect, which I think will also assert itself. As China starts to slow, that geopolitical piece becomes more important and more prevalent and more pronounced, actually. So I think, unfortunately, this is the world that we live in. The risk that we really haven't worried about in the past 10 years is really heightened here around geopolitics, and I think it means you need extra risk premium as a result.
Greg, how much time do you spend thinking about Japan? This is probably the most exciting moment for the country in at least a decade.
Yeah, well, more, I'd say. So, I mean, speaking of regime shifts, so, end of the Kuroda era, But it's an open question as well. So
Worried about in the past 10 years
will
is
rates
really,
move higher?
here around
Maybe a little, not a
geopolitics,
lot.
and,
But
I think it means you need.
I think Japan is very much stuck to a large degree. But I think the bottom line, whether it's Japan, U.S., Europe, is that higher rates, all else equal, are better, right? They're better for savers, pension funds, and the like. And so I think we're in a much more natural world, a much more natural state of investing. I think that's all good.
But Greg, when you speak to investors or your clients, do they ask you about Europe? Do they ask you about Japan, or they just pound you with Fed questions?
Well, it's always, well, the Fed is definitely the number one question, but it is a global marketplace, and there is a revisitation of global investing, right? When in the U.S. And in Japan, with rates at such low levels, it really forced investors outside those jurisdictions. So what I think you'll see over the course of the next year or so is just continued kind of repatriation of funds back to kind of the home bias, right? So I think that all needs to kind of settle and shake out.
Well, not dull. Greg,
not dull at all.
Thank you so much for joining us. Greg Peters, our Managing Director and Co-Chief Investment Officer of PGIM Fixed Income. Now, in the last couple of minutes, we also have some breaking news out of China. We understand through the Wall Street Journal that China is poised to create a news government agency to actually centralize the management of the country's store of data. Again, we've been looking at their relationship with technology and data gathering. We understand through the Wall Street Journal that the News National Data Bureau is expected to become the main Chinese regulators on various data-related issues. And then multiple ministries had shared the oversight, and we understand this is probably centralized. The latest news coming out of the National People's Congress. Coming up, we talk coffee. Andrea Illy, the chairman of Illy Café, joins us to discuss consumer confidence in a cost of living crisis, and of course, the future of the coffee industry. That interview in just a couple of minutes, and this is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to a Bloomberg Business Flash. Here's Samuel Etienne. Hi, Sam.
Hi, Francine. Italy's state lender CDP says it's teaming up with Australian infrastructure fund Macquarie on a bid for Telecom Italia's landline network. The offer counters one last month from US investment firm KKR. Both bids are said to value the Italian asset in a range of 18 to 20 billion euros, including debt and some performance-based earnout. SoftBank-backed UK chip designer Arm is reportedly seeking to raise at least $8 billion in a US IPO. Reuters says Arm is expected to confidentially submit paperwork for its listing in late April. Bloomberg earlier reported that bankers had pitched a wide valuation window of between $30 and $70 billion for the company. The new CEO of Shell has told the Times newspaper that Britain is less attractive as an investment destination because it's failing to match green energy subsidies. Well, Sawan says the UK should take a page from some of the things that the US has done recently. He also criticized the shifting tax regime and said the government's energy windfall tax. Tesla has cut the prices of its Model S sedan and Model X SUV in the US for a second time this year. Tesla sells its cars direct to consumers and often tweaks its pricing. The latest moves come even though Tesla drastically cut prices in January in a broad bid to boost sales. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg.
Etienne, thank you so much. Now, coming up, the chairman of Illy Café, Andrea Illy, joins us to discuss the outlook on coffee, my favorite subject, and the consumer trends to watch this year. That conversation is up next. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
News breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get to another exclusive conversation, probably with one of my favorite subjects. With interest rates heading higher and the soaring cost of living biting, what's the outlook for discretionary consumer spending? We're talking coffee. I'm very pleased to be joined by Andrea Illy, the chairman of Illy Café. Thank you so much, Andrea, for joining us. I have to disclaim that coffee, especially in a newsroom that wakes up at 3 in the morning, is more of a national obsession. How do you see our consumption of coffee changing through lockdown into the next 2-3 years?
Well, coffee, we always drink coffee. No matter good time, bad time, coffee is always there. Because with good time, you celebrate, and with bad time, you encourage yourself. It's good for the dynamics, the, professional and social life. So consumption is always
So you're
stable.
not worried about the trend, but do we consume coffee differently than we used to?
A little bit more at home, because thanks to, smart working, people maybe go less often to office, and they stay home and they consume more at home, so they're seeking for better homes, well equipped with coffee machines, portionate systems. So we used to be 60% out of home and 40 at home. Now it's, during COVID, this has been reverted. Now it's 50-50, and we think we will stay there.
So, Andrea, where's your biggest area of growth? First of all, when you look at, I imagine that it's different because you have many more Italian coffee shops in Italy that people, drink at the bar very quickly, that the composition of how much you sell in bars compared to at home is different, for example, in the UK, in Italy, or in the US.
Well, super premium Italian espresso is growing internationally because it's also leading, it's a kind of a driver for growth for premium coffee as well altogether. This interesting decommoditization of coffee from a pure functional beverage to an experiential one is really so dynamic. And this is why we export more and more. More than 2/3 of our sales are now internationally in 147 countries.
Right.
So we are definitely the most global coffee brand. And there is so much room for growth. For the future.
Yeah, so first of all, this is exactly what I need at 5 in the morning, a super premium Italian espresso. Is there a danger that if you become too big, you become less luxurious, so you lose a bit of that super premium aspect?
It is still a niche brand, and we want to stay niche. The demand is growing, so that means that even though maybe the niche becomes the same, the market is growing because the demand for premium coffee is growing. And as far as diluting, let's say, the brand equity, I don't see this as a problem. And for sure, we will never compromise on quality. I'm coming back from Brazil now, where I'm constantly working with growers in order to improve their sustainable quality and also create the offer for production for the future is ahead.
So what do you make, and we've been looking actually at the price of coffee beans quite intensely, especially in preparation for this interview. Robusta coffee has rallied in terms of prices. What's the impact of that?
Prices of coffee are now volatile. There is a volatility which is now not driven any longer by the shortage of supply, which was 2 years ago as a consequence of this frost in Brazil. Now production is expected to be at least in balance with consumption, but because we don't have a clear figure about how much will be the production, still there is a little bit of volatility. So I predict this price to stabilize during 2023.
But if you look at Arabica, so if the price of Robusta, I mean, look at me, I'm like an expert in coffee, right? You have Robusta and Arabica. If Robusta, the coffee prices go up quite significantly, is it less likely that companies will blend it with the better Arabica?
Hopefully, yes, even though we don't deal with Robusta altogether.
So you don't
because
blend.
super premium coffee is only Arabica. So typically there is an arbitrage. So, but the other way around, when Arabica is too expensive, some roasters, they use a little bit of more Robusta in order to mitigate the price increase.
Andrea, how's the expansion in the U.S. going? Are you getting business? Are you where you want to be, or is there going to be a lot more expansion?
We are where we want to be. It's our second largest market after Italy. We seek for the U.S. to become medium, long-term the first market altogether. So we are investing in distribution. We are in product development. We are on target, and still we will improve our, let's say, penetration in the years ahead.
Will you IPO? I ask you this every time. We ask the chief executive every time.
It's in the plan. We now have a co-investor, Round Capital, with a 20% share. In the plan is that their exit will be within 5 years or 7 years with an IPO.
So are you waiting for like ideal market conditions, or is there, in your mind, when does the IPO happen?
Preparing the company, preparing a nice equity story. And so we hired a new CEO, Christina Scocchia, who took position last year. She already did a first year quite good. And now we are in the process of really preparing the equity story.
Andrea, talk to me a little bit about China and the fact that it's reopening quite significantly. Does that impact you? Does it impact Italy, or does it impact the price of coffee beans?
It's not impacting really our performance, because we used to sell a lot of coffee during the lockdown period at home. So China is growing double digits. It's a promising market, also because there is more and more, let's say, cultural cross-fertilizations are getting these Western lifestyle habits, which is, of course, good for coffee. And we keep growing.
Yeah, I'm sweating because we're going to have a coffee afterwards, Andrea, in our pantry at Bloomberg. So I hope it's to the high quality. You were also telling me, actually, that when did we invent coffee or start drinking coffee? In what, the medieval times?
In Europe, continental Europe, we started drinking coffee around the half of the 17th centuries. And the good news is that it took modernity, because before coffee, people were drinking beer for sanitary reasons, because there was alcohol. So from 3-4 beers per day to 3-4 coffee, this is why we got enlightened, and not accidentally. It started the Illuminism, the Cultural Revolution, Scientific Revolution, all the modern trends, which created the society we are accustomed to now.
But now, I love that. Beer, from beer to coffee, certainly, I'm sure, made people a little bit more aware of certainly the news out there. Are people drinking less coffee but higher quality coffee now?
No, they typically don't drink less coffee, also because there is a kind of self-adjusting dosage. With higher coffee means higher quality, means lower caffeine. So this is why people have two incentives to drink more, because they can have more caffeine, and more flavor.
Okay, there you go. Sponsored by Andrea. Thank you so much. I'm not even going to ask you about Starbucks, I think, putting olive oil in their coffees, because I know then you need to be sedated. That was Andrea Illy, the chairman of Illy Café. Now, coming up, we have an exclusive conversation with the chairman and chief executive officer of JP Morgan Chase, Jamie Dimon. He sits down with an exclusive conversation with Ed Hammond. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
We're on this long road, and we are not necessarily knowing where the end of that road is going to be.
My view is that we're going to see a slowdown in the U.S. economy in the next few months, and it will be significant. I think in many sectors we're already seeing it.
It doesn't appear as if the consumer is increasingly confident in their financial footing.
There's still a lot of excess buffers in financial markets and among households.
We still like banks because valuation is supportive, balance sheets are supportive.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Credit Suisse loses one of its biggest backers. David Harrow of Harris Associates sells the firm's entire stake in the embattled Swiss bank. Citigroup plans to almost double its staff in Paris. The expansion comes as Citi and its rivals continue to grapple with life after Brexit. And China sets a cautious growth target. That's likely to mean a smaller boost for an ailing global economy. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, I read with interest that there are 13 days ahead of us, which will be key for the direction of markets for the rest of this year. We're going to get jobs data, Powell speaking, a Fed rate decision, CPI out of the US, lots of things to watch out for.
Yes. As usual, the days ahead are important to the future of market prices. Let's take a look at what's going on right now in terms of U.S. pricing. Futures going a whole lot of nowhere. S&P futures unchanged. I noticed that NASDAQ futures were up a little bit. Dow futures were down a little bit. But basically, the idea is that the markets are paused now as they assess what China's weaker growth goal means. Obviously, it won't spur global growth as much as it would have. However, it's not going to spur inflation in that case either. So we have to decide if this is a good thing or a bad thing. And we're going to talk about those goals and the MPC. The U.S. 10-year yield is coming down 2.5 basis points, but still at a relatively high level, close to 4% at 392.64. It is not 4%, though, so we raised over that level for really the entirety of the curve last week. Now we've come back down. That's good news for stocks as we continue to come down. Yields offer less of a headwind to equities. Crude is off a little bit, but $79.12 is a relatively high price, especially considering the fact that you have lower expectations for Chinese growth. Does that mean that Chinese consumers are going to be tanking up less often? It certainly doesn't look that way. It's not reflected in this price unless this is a demand issue. it's interesting to see WTI trading so close to 80. And then Bitcoin right now down, holding around the $22,000 level, but it's incrementally fallen over the last few sessions from basically 25 grand to 22 right now. Take a look at Asian markets. They're up in terms of the broader market. The Asia Pacific is up 0.7%. The Hang Seng is a big gainer as well. You can see it gaining, not a big gainer. It's in positive territory even with these lower growth targets. You see it gaining about 0.2% right now. The Nikkei is up, closed in Japan over 1%. So the bigger gains in Japan than we see in China. And right now, the U.S. dollar strengthening a bit against the yen at 136.07. Anna, what do you see in Europe?
Yeah, Matt, what we see in Europe is a kind of mixed picture, actually. If we look at the sector breakdown, 2/3 of sectors are in positive territory, and the Stock 600 is just in positive territory. So we are seeing moves a little bit higher, and we're benefiting from some of the read across out of China in some senses, not on basic resource stocks. Those are weaker. We've seen iron ore coming down, copper coming down as a result of that modest growth target in a Chinese context, of course, around 5% coming through from the MPC. So that's weighing on mining stocks in London, which is hurting the London market. The consumer products and services sector, though, is doing pretty well. This and travel and leisure. And there does seem to be an expectation that perhaps the domestically driven, consumer-driven part of the Chinese economy is where the future is going to be, less so manufacturing, even though this is, of course, still a massive manufacturing economy. But that's what a lot of guests have been talking about today. And interesting in that context to see that some of the consumer products, luxury names in Paris move higher. Brent crude, the other side of that story, in keeping with what we're seeing on basic resource stocks, we're seeing Brent crude come down as oil prices are retreating. Matt's just been through some of this detail with regards to China and expectations for growth there. Telecom Italia up by 2.9%. We've been talking for decades about the best way to structure ownership of some of the infrastructure around the telecom sector, and this is to do with landline networks. We're now seeing a big bidding battle. KKR going up against Macquarie in tandem with an Italian state-backed lender, and so they're competing for the landline assets at Telecom Italia. We'll keep an eye on that deal. And Credit Suisse in focus, down by 1.2% today. This after we've heard at the weekend that a big shareholder then, who's been at Credit Suisse for 2 decades at least, Matt, has decided to sell his stake.
Yeah, huge news. I was honestly a little bit shocked when I read that. David Harrow is the shareholder. He shared his view on Credit Suisse with Bloomberg last August.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it and that's it.
Joining us now for more from Zurich is Bloomberg's finance reporter, Marion Halftermeyer. Marion, investors clearly disappointed with this, one of the biggest backers bowing out.
Yes, exactly, Matt. This is a big deal. They've been, as you've heard David Harrow say himself, they've been with the bank for a long time, and they really stuck through with this bank after a couple years of scandals and lacking profitability and huge losses. And ironically, they had been calling for a solution that stopped the investment bank from losing money for the broader bank, and the bank did do that. They said, okay, you know what, we're going to carve out this investment bank into CS First Boston. Now what we understand is that, you know, Harris Associate has said, you know what, we're going to sell out anyway because the plan you've presented us is too cumbersome, too complicated, and eating too much capital that it's just not worth it for us to stick by you anymore.
Right, so that was the verdict, and they don't mince their words. Certainly, in some of the language to the FT over the weekend. Now, what supporters does Credit Suisse still have left, then, Marion? Are we looking here at the Middle East?
Exactly. So the main shareholder, so who has replaced Harris Associates, is the Saudi National Bank. They participated in the capital raise last year, and so they've now got about a 10% stake. So they're quite supportive. And then you can't forget about QIA, Qatar Investment Authority, that has also been with the bank for the last decade or so. And they continue to hold a significant stake and continue to support the bank in their plans and restructuring.
All right, we're going to continue to obviously follow this story, not only Credit Suisse, but what happens with First Boston. Marion, you got a great story out on the terminal about their Goldman Sachs-like partner structure as well. So we will follow the evolution of Credit Suisse as we watch also UBS. Marion Halftermeyer, thanks very much for that. UBS, as I mentioned, cutting employee bonuses for last year by 10% to a $3.3 billion slump. $1 billion after a slump, I should say, in mergers and capital raisings. Meanwhile, the CEO, Ralph Hamers, gets a bump. So cutting bonuses for the lower ranks, but giving the CEO more money. Great story. And in Paris, Citigroup, speaking of banks, or sticking with banks, I should say, is building a new trading floor as the Wall Street giant prepares to nearly double its staff in the French capital. Joining us now is Bloomberg finance reporter Jennifer Serain. So, Jenny, what is Citi doing in Paris? Why ramping up now?
Yeah, you know, it's really all tied to Brexit and the fact that they are still needing to put more and more traders and their risk books back out on the continent. So you see them adding traders, support staff, different operations folks, and they're looking to bring their staff in Paris up from about 130 to 250 in the coming years.
Okay, and we're hearing a lot more and more about companies choosing to beef up operations outside of London. This is a Paris story. We hear them in Frankfurt, in Dublin, in Amsterdam. What does this mean then for London's status as a hub for finance and commerce?
Yeah, I really don't think it's a winner-take-all. So I think, you know, London still is as a main hub for Citigroup and other banks, and there's still thousands and thousands of employees here. But you will see this continued move out, especially as these banks slowly convince workers and really come to grips with these different regulations. You're going to see more folks in Paris, Frankfurt, Dublin, Milan. But London, you know, London is London.
All right, Jenny, thanks very much. Jenny Serain there reporting on some of the moves out of the city into Paris. Let's get to China, though. The big story maybe behind markets this morning. It has set a modest economic growth target, suggesting that there will be less of a boost to an ailing world economy. Beijing's goal for GDP growth this year is around 5%, modest for it. Economists had expected a more ambitious target following a rebound in consumer spending and industrial output following the reopening, basically, and the reversal of COVID-0. Enda Curran, our chief Asia economics correspondent, joins us now. So is this bad news for the global economy? And I was listening to Christian Mueller-Glissman at Goldman Sachs this morning, who said there's good news here as well. It won't be driving inflation.
Well, look, it's probably, at the very least, an attempt to manage expectations on the Chinese side. A lot of economists were talking about 5.5% for a growth target. That's probably where Wall Street was. But the officials have come out with 5%. And the thinking is that target should be hit pretty easily, Matt, because of the pickup in consumer and business sentiment on the back of COVID-0 coming to an end. We've already had better data to kick off the year. Remember, last year, China missed its growth target by a long mile. Growth came in at 3%. It had targeted 5.5%. It's setting 5% this year. So that's being seen as something of a floor, an achievable target, and an attempt by the authorities just to manage expectations for stimulus.
Okay, and what has been the messaging then on technology from China's MPC? Because the growth target was one thing that caught everybody's eye, but also a lot of big names in Chinese technology waiting to see what the regulatory environment looks like and whether they actually get their seats on the MPC still.
Yeah, well, the tech tycoons got a cold shoulder at the Congress, so to speak, but certainly the broad message around development and development ambitions to turn China into a technology superhouse. I mean, that seems to be a central focus of these meetings. We had commentary from President Xi Jinping today through the state media, doubling down on this idea that China has to move now to the next leg of its manufacturing development. And essentially that's code for it has to stand on its own 2 feet in the technology space. It cannot rely on the US, for example. Hardly a week goes by now without getting news of US export controls on key critical technology into China. China's now responding, trying to ensure that it can develop on its own 2 feet. And that seems to be the message coming from the MPC, that they are going to double down on that. And that's why we'll expect to see a lot more focus on development, I think, over the coming years.
All right, Enda, thanks very much. Bloomberg's Enda Curran, their chief economics correspondent in Asia, taking a look at what's going on in China in terms of its growth target. Let's take a look at some of the stocks we're watching in the pre-market here in the U.S. this morning. Shares of Hertz Global Holdings are gaining after Barron's recommended buying the warrants as a good alternative to the stock. Nonetheless, investors are pushing the price of the underlying shares up in the pre-market. Also, watch shares in Tesla after the EV maker slashed prices on some of its most expensive models. Yes, again, this isn't the same old story. I think it's $5,000 on the Model S, $10,000 on the Model X, this in the U.S., and Jefferies also raised its price target on the stock to $230 from $180. Clearly, they've surpassed the former target. And watch U.S.-listed Chinese stocks after Bloomberg reported that the Biden administration is nearing a completion of an executive order that would restrict U.S. investments in China's technological advances, a move that risks dampening the already fraught relationship between the two countries. Anna?
Matt, coming up on the program, we will talk about the global economy. Nobel laureate Michael Spence joins us. He has thoughts on the post-pandemic global economy. We'll get to that conversation shortly. And JP Morgan Chairman and CEO Jamie Dimon sits down with Bloomberg's Ed Hammond for an exclusive interview later today. That's live today at 11:40 a.m. New York time, 4:40 in London. This is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Exclusive today, J.P. Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond, live from the J.P. Morgan Global High Yield and Leveraged Finance Conference in Miami, only on Bloomberg TV and Radio.
Welcome back to Bloomberg Surveillance. This is the early edition. We are looking at market pricing right now of a terminal rate of 5.43%. That would be the effective rate, meaning that the Fed would be raising to as high as 5.5%. You can see that the Fed's median dot was for 5.25%. Okay, the effective rate of 5.1%. We're going to use a whole bunch of different kinds of Fed funds pricing here. But the bottom line is the market is now going higher than the Fed had in its dot plot. And of course, Fed speakers have said they may need to raise rates higher for longer. Ben Rahm joins us now, Bloomberg's cross-asset strategist, to talk about what exactly this means. Ben, does the Fed definitely go now to 5.5%? Is there a chance they push up to 6%?
Morning, Matt. I do think that there is a chance that they may raise it to 6%.
And a lot will depend on what this week's non-farm payrolls data show. Of course, the consensus is that we are not going to get anywhere near the outsized print that we got for January, but still the expectations are that we'll get a pretty robust number. If we get that robust number, and if hourly earnings growth is pretty strong, and if the jobless rate is ticking around 3.4, 3.6, that's not going to bring the labor market into equilibrium. As we know, the Fed thinks that the labor market will get into equilibrium at 4.6% jobless rate. We are far off from those levels. So the Fed has to willy-nilly keep going higher. And that means 550 is a chance, and so is 6% a chance, definitely.
Okay, so that's how high we could go. Then, do we need to, where are market expectations versus what the Fed is telling us at the moment then? I mean, I ask this because we're going to be hearing from the Fed. We'll hear from Jay Powell this week, won't we? Larry Summers, ahead of this appearance on Capitol Hill by Powell, has been suggesting that perhaps the Fed chair needs to open the door, in his words, to 50 basis points, making it clear that rates could step up as well as having stepped down previously. Is that a door that you think should be opened, is likely to be opened?
I don't think that's a door that the Fed is going to open the door to a 50 basis point hike, simply because they've stepped down to a 25 basis point hike. Now, if they go ahead and raise it by 50 basis points, the signaling to the market and to the economy will be very negative, because they will think that the markets, the message that will be sent out to the markets is that the Fed is panicking in the last lap of the inflation push, and therefore they're losing control of inflation, and the markets will panic, and it will cause an adverse feedback loop in the market, which the Fed will be mindful of. And therefore, I don't think the 50 basis point option is anymore on the table. They will keep going at 25 basis points. And they are thinking the labor market will cool sooner or later. And those tech layoffs that we saw earlier on will feed through probably from March, April. So that's what they're waiting for. So there is no urgency in the sense. So they will keep going at 25 basis points.
Ben, I recall reading a story, I think 2 weeks ago, about how global investors were preparing for the downturn of the dollar. Clearly, when we look at the Bloomberg Dollar Index, when we look at global markets, that hasn't happened. What's your expectation for the greenback?
I think the greenback will stay supported around current levels, simply because the Fed is going to keep going, as we just discussed. But the key engine for higher dollar is predicated on real rates. And if you look at real rates in the US, whether the 5-year rate or the 10-year rate, they haven't really pushed meaningfully higher than we were at the start of the year. So at the moment, the dollar is going to tread water around current levels. It's not going to go to the peaks that we saw last year on the Dixie, for instance, to 114 levels. I don't think that's on the cards.
Then can I ask you about what's going on at the European Central Bank? There does seem to be a debate happening right now. Markets increasingly factoring in, pricing in higher rates in the Eurozone. Is that because they're just factoring in what they think the ECB is going to do? Or is it because they think that the ECB will hike and regardless we'll have higher inflation? What do you think is being acted on here?
I think there are two factors that the market is cognizant of now. The ECB turns out much more hawkish than even what we were thinking about 1 month ago, and that's the consistent signal from the ECB. And the latest inflationary prints that we have got from the Eurozone don't give any credence to the fact that, the ECB estimates that inflation this year is going to be, HICP inflation is going to be 6.3%. Looking at the latest prints, we don't get the impression that it's going to converge to even 6.3%. So we are at 250 on the ECB deposit rate. So that means that the real policy rate is deeply, deeply negative. And in this environment of extraordinary inflation, to have deeply negative rates means that the ECB will have to work harder to control inflation, and which is why the markets are thinking they need to perhaps push to even 4%.
Okay, Ben, thank you very much. Thanks to Ben Ram of the Bloomberg Markets Live team. For more market analysis, you can check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Please, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Now, keeping you up to date with news from around the world, here's the first word. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War say the Russians will probably not be able to encircle Bakhmut anytime soon. There's been a breakthrough in a long-standing feud between Japan and South Korea. The South Korean government says it would resolve a dispute over people forced to work for Japanese companies during Japan's colonization of the Korean peninsula. The conflict had disrupted relations on everything from trade to security. A second Norfolk Southern train derailment in Ohio within a month has Congress calling for rail safety legislation. Saturday's derailment happened outside Springfield, Ohio. That's about 180 miles west of East Palestine, where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned Thursday when he testifies before a Senate committee. And U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the top concerns is that TikTok keeps American data.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounded like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index. But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool and I don't want to move to the suburbs. Like,
this episode is just Joe taking like advice on handling his rent.
I just wanted to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Credit Suisse loses one of its biggest backers. David Herro of Harris Associates sells the firm's entire stake in the embattled Swiss bank. Citigroup plans to almost double its staff in Paris. The expansion comes as Citi and its rivals continue to grapple with life after Brexit. And China sets a cautious growth target. That's likely to mean a smaller boost for an ailing global economy. I'm Anna Edwards in London with Matt Miller in New York. And Matt, as we look out across the week, we're going to hear from Jerome Powell, of course. The jobs report, clearly the data point of the week, though.
Yeah, the jobs report is the data point of the week, but that comes at the end of the week. So to kick off the week, I think a lot of us are focused on the Chinese economy and the goal that the Chinese have set for themselves in terms of economic growth. 5% in our terms sounds like a lot. It's pretty tepid in Chinese terms. And the question is, are you concerned that they're not going to boost, they're not going to be the engine of the global economy the way we would have expected, the way they were pre-pandemic, or are you happy that they're not going to be boosting inflation and central banks around the world aren't going to have to keep raising rates to quash it? Right now, S&P futures are pretty undecided. Absolutely nothing going on after the gain we had last week in the cash trade in futures to kick off the week. We do have rates coming down a little bit. Remember, we were up over 4% on the 10-year, really across the curve. Now we're down 9 basis points from that at 391.27. So that at least is a tailwind for stocks this morning. NYMEX crude remains pretty high. For WTI to see a figure close to $80 a barrel is a lot higher than what we've seen over the past few weeks. We've been looking at a 74, 75 handle. Now we're looking at $79 a barrel for West Texas Intermediate. And then Bitcoin remains relatively low in terms of the range over the past couple of weeks, because we had approached 25 and we're holding there for quite a long time. Now we're back down at 22,390. In terms of the pre-market, I mentioned Hertz this morning because Barron's had a piece out on Friday about a strategy involving buying warrants. They said it's a better alternative than buying the stock. Nonetheless, investors have pushed up the price of the underlying shares. Right now, Hertz Global Holdings up almost 5% in the pre-market. Watch shares of Tesla. There has been a lot of back and forth. They cut prices, then they raised prices. Now they're cutting prices again on the most expensive models in the U.S. $5,000 now off on the Model S, $10,000 now off on the Model X. Of course, these are aging designs, and maybe they have a whole lot, well, certainly they have a whole lot of margin baked in there, so they can afford to do this. The stock not quite reacting in the pre-market. We'll watch it at the open, 198 for Tesla. I should also point out Jefferies has raised its price target on Tesla to 230 from 180. Apple right now up about 1%. Goldman Sachs initiates coverage with a buy rating on Apple, saying the iPhone maker's growing installed base of users underpins the Apple as a service opportunity. That's pretty clear, but Goldman Sachs is a big name, so that should help the stock this morning. And then Rio Tinto down. This is really part of the fallout of the Chinese growth target being a disappointment because, of course, you want to watch commodities like iron ore for steel making, Dr. Copper, aluminum, oil, etc. on China. If they're not going to grow as much as you think, then we're not going to need. They're not going to need as much of that stuff. So makers of that stuff are going to do poorly in today's session, and Rio Tinto is kind of a poster child of those makers. Anna, what do you see in Europe?
Yeah, I'll pick up on exactly that same theme then, Matt. Here we're kind of range-bound in Europe and drawing attention to Brent crude, moving for some of the same reasons as you highlight there with the Rio Tinto share price. The story out of China, the lackluster growth target of 5%, the fact that the economy wants to pivot away from maybe commodity reliance, more towards consumer-driven expenditure, and so that plays badly for Brent crude, it seems, down by 1.5%. Plays well for consumer products and services here in Europe, though. We see some of those French luxury names doing pretty well today, some of those up by more than 1%, and as a result, that sector goes a little higher. The net result of all of that, weakness for commodities in London, strength in Paris for the luxury goods sector, means that Stocks Europe 600 goes absolutely nowhere as we wait to hear from Jerome Powell and we wait for that jobs report later on this week. Here's an interesting one that we're keeping track of this week, though. Credit Suisse, of course, we have covered the travails, the twists and turns of the story around this particular Swiss lender for many, many months now. And the latest news is that we've seen one of their previously big backers, Harris Associates, deciding to sell all of their stake in the business. They still have the Saudi National Bank, so we'll be watching to see if we get any response there. But that's certainly some news flow that has put some downward pressure on the share price, even as it is not far from record lows, Matt.
All right, let's talk about the Chinese situation especially, but let's talk to Nobel laureate Michael Spence right now. He's currently a senior advisor to General Atlantic and chairman of the firm's Global Growth Institute. Spence won his Nobel Prize for his theory of market signaling, and he has a warning for the post-pandemic world. Things are going to be different from now on. Michael, great to have you on the program. Thanks so much for joining us. I wonder if we can start with China, because you know, we're so used to this economy being the engine for global growth. And now if they have a tepid forecast, after they've reopened, after they've ended COVID-0, a lot of people will be scratching their heads, like me. Why aren't we seeing a huge jump in the commodities that this engine needs? Are things going to be different?
Well, the Chinese certainly hope they're going to be different, and you touched on the reason a few moments ago. I mean, for the sustainability of their growth, they really need to manage this shift to a greater reliance on the consumer as a source of demand, avoid excessive activity in the construction area, and stabilize the real estate sector altogether. And so I think, you know, the growth may be pretty respectable. I think 5% is pretty good coming out of COVID. And it'd still be something of a growth engine for the global economy. But a knee-jerk reaction that they're going to go back and buy a ton of commodities, I think, is probably not right. And the markets are guessing that that's probably true.
I guess one of the biggest changes that I see in your notes in a post-pandemic world is something that we could see happening already before COVID hit, Michael, which is that the global population is aging, and it's pretty extreme. We have a lot more old people and far fewer young people. We're not reproducing at the same speed as we had previously been. What does that mean for our future, for Social Security, for taking care of, you know, our parents and grandparents? How is this all going to look?
Well, it's one of several sort of secular trends that are distinctly non-transitory, that are restricting the supply side of the global economy. So, aging has occurred in countries that account for over 75% of the global economy. That's only a third of the global population, and those other economies, the young ones like India, may eventually get to a size that this trend is partially reversed. But basically, we have, in some places, a declining workforce. It adds to inflationary pressure because in the developed countries, people have pretty decent balance sheets. They stop working, labor force declines, they don't stop consuming, right? So you get an automatic mismatch relative to the past with respect to supply and demand. And then you have these fiscal pressures you're talking about. You have rising dependency ratios, the prospect that the young people are going to have, via the tax system, have to look after more old people. And there's lots of, unfunded liabilities lying around in this territory. So it's a big change. But when I think about it, I focus on the sort of the declining supply side elasticity that we got so used to over 3 or 4 decades in the global economy, when massive numbers of young people entered the global economy and became productive. So I think that's the main event.
Yeah. And Michael, yes, we often do think about the fiscal challenges and the tax base, but you're drawing our attention to the inflationary nature of these developments, which I think is interesting. And something else that I know that you study as a sort of long-term trend that could also be inflationary, decoupling and the future of globalization. You have for decades studied convergences and divergences across the economy. Where do you think we stand on the globalization and de-globalization thread now?
Well, we're obviously experiencing fragmentation, but I think the more important trend, which doesn't look like it'll reverse, is the global economy is subject to an increasing number of high frequency and fairly severe shocks, to the point that it's a macroeconomic event. And the response of the business community, particularly the people who operate global supply chains, but it also occurs in finance and in other areas, is diversify their sources. And that's backed up by increasingly, loud noises from the policymakers that this is the right thing to do. And I'm not saying it's the wrong thing to do. When you have shocks, you diversify to try to protect yourself, but that's expensive. I mean, you can see that in Europe. We're diversifying at pretty high speed away from, dependence on Russian fossil fuels, and that's not a cheap exercise. So it just adds more to the same. It raises the cost of doing business and contributes to a supply side move that doesn't help with the inflation fight.
And Michael, you make the point, obviously, that we've dealt with COVID in recent years, and one of the things that has happened as a result of that is something else is on the rise, and that is global debt levels, sovereign debt, your focus in particular. This obviously matters then if rates go higher, stay at elevated levels. What do you anticipate then on rates? Because this will have such a bearing on the ability of governments to pay back these debts.
Yeah, so I mean, we do have rising sovereign debt rates. This wasn't a mistake. I mean, it was part of the response to the pandemic, and it's a lot better than the alternative, which is leaving households and businesses, floundering around trying to survive. But we're over 100% sovereign debt to GDP ratio globally, and we're doing that in a rising interest rate environment. So you put your finger right on the important issue, Anna, which is, are we going into a rising interest rate environment that stays at elevated interest rates? That is, do we move to, after the inflation fight, to a new equilibrium in which the real rate of interest and a whole bunch of other interest rates are higher than what we were used to in this long deflationary period that we seem to be exiting? My best guess is yes. I mean, this is not an easy thing to determine, but when I add up the supply side constraints, I think that potential inflationary pressure is going to be persistent. And so I think we're in a rising interest rate environment that reduces fiscal space, and it makes all kinds of things challenging, including the climate change agenda, because that requires a ton of incremental investment.
I think it's a good point. This is the sea change that Howard Marks talks about now, a new regime of higher rates. I know you're an economist. not giving investment advice, but I take from your comments that healthcare is one area we really need to focus on, right? If we're looking at an aging population, resources are going to go there. And then India seems to be another kind of golden opportunity if they're one of the big populations with the rising amount of young people.
Yeah, I mean, I think India, you know, is a big economy. B, it probably has the highest potential growth rate in the world, you know, among the major economies, just because of the stage it's at, you know, per capita income, $300,000, you know, $3,000, you know, big increases in the demand elasticity for things like cars and so on. I think India is looking promising. I mean, you know, any country can have sort of disruptive events, you know, sidetrack them for a bit. India had that in the second Congress term, you know, before the BJP and Prime Minister Modi came to power. But I think the enthusiasm for India, look, and I'm not commenting on whether markets have got the valuations exactly right. That's not something I'm great at. But I think in terms of potential, they have a dynamic, you know, digital ecosystem. They had the geo-revolution. The mobile internet users have just had a startling rate of increase in the last 5 to 6 years. I mean, there's just a lot of pieces coming together. So on the India side, you know, I'm on board.
Michael, thank you so much. Thanks for joining us. Nobel laureate Michael Spence with us to talk about the direction for the global economy from here. Coming up, James Lord joins us, Global Head of FX and EM Strategy at Morgan Stanley. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, the dollar's recovery from a 10-month low has run into a speed bump with the rally trailing behind the surge in Treasury yields. Joining us now is James Lord, Global Head of FX and EM Strategy at Morgan Stanley. And James, you know, the dollar is one asset that I think everyone pays attention to, has to pay attention to. Where do you think it's going? Because we had a pretty tremendous comeback from the lows, but it seems to have stalled out.
Yeah, absolutely. I mean, I think we're fairly range bound for the dollar in the very short term, but I actually think that the rebound in the dollar probably won't go much further from here in the medium term either. Actually, we're quite biased to move back towards a short dollar view for the remainder of 2023. And there are a few reasons for why. I mean, if you think back to like where the dollar came from over the October to January sell-off, this was a period of where, you know, everyone was quite optimistic about the rest of the world. China was doing well. Europe was performing well, and the US was we all thought was sort of slowing down. Now that narrative has changed a little bit, and the US is clearly doing much better than we all thought. But we're not going back to a world of US exceptionalism in our view, where, you know, the US data just accelerates further and further from here and leaves the rest of the world in the dust. Actually, you know, China, despite this morning's slightly softer GDP growth target that they announced, we think will grow much faster than that. Europe also doing very well. Rate differentials aren't really moving a great deal in the US's favor.
Okay, so range bound on the dollar and not really the rate differential story we were dealing with over the last few years. James, let me ask you about that Chinese story then. I know that you have a long on the Chinese currency. Where does that take us to? What's the thinking behind that?
Yeah, so we're bullish on the Chinese economy. We're expecting to see about 5.7% GDP growth for this year. I think we need to place that 5% target that was released this morning into a little bit of context. So that number was actually decided upon in the economic conference in December. And if you cast your mind back to December, economic conditions in China were very different to how they are now. This was a very early stage of the reopening in China, very unclear exactly how it would go. And I think it's understandable that there was a degree of caution in setting that GDP target in the way that they appear to have done. Now, you know, since December, actually the data have come in very strong. The reopening has gone extremely smoothly from a growth perspective. And I think actually in the end, the GDP number will be much stronger. I think we may be looking at a similar story to what we saw in 2021, when they similarly also set a pretty conservative GDP target, and then the end result was significantly stronger than that target. So I think we should view this target rate of 5% as more of the sort of minimum rather than something that they're really aiming for.
We had a great big story over the weekend, James, about dollar scarcity that's causing real problems in EM. Is this a surprise to you, or you know, how quickly it's gotten this bad? Is it a concern to you going forward in emerging markets?
So, I mean, whenever the dollar's going up and US rates are repricing, there are always going to be some emerging markets that struggle in terms of their outlook. I mean, a lot of emerging markets do have high levels of debt, and refinancing that debt obviously becomes much more challenging in a world of high US rates. But I think if we look down the list of the broad range of EM currencies that there are, the countries that are really struggling are really more the exception than the norm, right? It's most EMs run pretty good external balance sheets, and you know, current account positions are in reasonably good shape. And I think if you look at how EM currencies have actually behaved in this cycle, you know, in total return terms and also even spot terms, ignoring the interest rate differentials, actually since the dollar started to rebound at the beginning of February, most EMs have done very well against the euro, done very well against the yen, done pretty well against sterling, and it's only really the dollar where there's been a bit of pressure coming through. And so that really tells you that this is a dollar story. This isn't really an emerging market story where you have real emerging market weakness. Okay. You know, as we say, like, yeah, we think China will do well, and that will spill over to the rest of the EM as well.
James, thank you very much. Thanks for joining us. James Lord of Morgan Stanley with his thoughts on FX markets. Later today, don't miss our exclusive interview with the JP Morgan Chairman and CEO, Jamie Dimon. That's at 11:40 a.m. in New York, 4:40 p.m. in London. This is Bloomberg.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Welcome back to Bloomberg Surveillance Early Edition. Now, let's focus in on some of the key market events of the weeks ahead. 4 major events over the next 13 trading sessions will be key catalysts for markets. It starts with Fed Chair Jerome Powell's testimony in the U.S. Senate. That takes place tomorrow. Bloomberg's Valerie Teitel joins us now with a briefing. Valerie, take us through the key events ahead then.
It's March Madness market style, Anna. It's going to be a big one for macro. It all kicks off with Powell's testimony. His 2-day testimony starts tomorrow. The key questions there is he going to repeat this word disinflation? He used it ad nauseum when we heard him nearly a month ago, but there's been a hot CPI print in between then and now. Does he continue to use that word? Also, what is his view on the string of strong data from the January? Does he see it as a one-off, or does he see it as a start of a new trend? We actually heard from Mary Daly on this subject this weekend. She said, and I quote, "It's not necessarily an indicator that the trend has changed. That's positive for the Fed." Then we move into the data. Payrolls, arguably bigger than Powell's testimony. Do we see any evidence of wage inflation, that this tight labor market is driving wage inflation? The moderation in wage inflation has been one of the bright spots from the Fed from that Jan data. All leading into the CPI report. Is core services CPI remaining stickier than forecast? And then on March 22nd, we get that FOMC decision. We get those key dot plots and the rest of their economic projections. Just how high will they revise those dots is the question markets are looking for an answer.
All right, some new dots. Valerie, thanks very much. Bloomberg's Valerie Teitel with the events we should be watching for. And Anna, I guess if Powell does things right, it'll just be the congressmen and senators that we hear from more than the Fed chair.
Yeah, well, we'll see whether he wants to communicate something substantial, a change to markets, or if he doesn't, and we'll get a sense of that.
That's it for Early Edition Surveillance. The OG is up next with Lisa, John, and Tom. We'll hear from Christian Horner of Red Bull Racing.
actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We're in this brave new world where we have more political, geopolitical risk, more fiscal, higher inflation, higher rates.
By virtue of having inflation, you eventually slow down and reduce the real balances, and the consumer feels squeezed.
There's still a lot of excess buffers in financial markets and among households.
Ultimately, it's a question whether the Fed takes the high road or the low road, proverbially and literally with rates.
If we do get to a 6% rate and have to hold at 6%, I think we're increasing the probability of a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from a beautiful New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures just about positive on the S&P 500. TK looking ahead to payrolls and Chairman Powell, a defining week for this market.
Single best line of the weekend, Michael Darter writing at Roth MKM. He says the Fed is in an awkward position. I thought that really captured the clumsiness of the moment. And this morning, the awkward position is defined by a spread out to a new record-wide negative 92 basis points as we speak, signals the week ahead.
New growth target out of China over the weekend. It has a 5 handle, but it's just 5%. Now, I made the point yesterday, Brammer, I think arguably that's maybe the best news that Chairman Powell and President Lagarde have had all year, maybe in the last month for sure.
On one hand, this is perhaps disappointing to people who are on this global recovery fueled by an incredible boom in China. On the other hand, this really reduces some of the potential inflationary pressures coming from China if it's just 5%. And, oh yeah, by the way, positioned perhaps to go lower going forward.
Looking forward to catching up with Endacurrent a little bit later. Need to catch up with Credit Suisse as well. This stock right here, David Harrow, David Harrow of Harris Associates saying this to the Financial Times. Why go for something that is burning capital when the rest of the sector is now generating kit? Eurozone banks year to date up more than 20%. This one right here, negative on the year. Tom, Harrow exiting that stake at Credit Suisse.
This is a storied career. Full disclosure, I'm a good acquaintance of Mr. Harrow's, but David has earned acclaim in international blue chip investment, and he's gone down in flames over a long duration with this holding.
I also wonder if this is going to be not the straw that breaks the camel's back, but this is such a long-standing backer of a company that now is getting so much Middle East money. Does that really lead to a question of where the leadership, where the ownership, where the influence is going to come from?
Ultimately, the problem David had, looking around Europe at the moment and Eurozone banks, European banks are performing really well. And not just in the Eurozone. Look to the other Swiss banks. UBS is up 20% year to date. Why would you watch all of that happening and stay in this, Tom, with trouble after trouble, quarter after quarter.
Yes, but that conversation could have been had 8 years ago, 6 years
That's
ago,
a good point.
10 years ago, whatever. The outperformance is there, and let's again remember you're capturing a ginormous dividend while you waited for the European banks to finally move.
Credit Suisse right now down by 1.6%. Just to whip through the price action for you. Squeezed out a week of gains on the S&P 500 last week. Can we add to it? Futures, let's call it unchanged on the S&P. Pulling back from the highs we printed last week, 4% plus on the US 10-year, back down by another 4 basis points on a 10-year at the moment, 391.27, and euro dollar, Lisa, just about negative here by 1/10%, euro dollar 106.27.
This week is going to be an important week, and I really wanted to set it up to give you a sense of all the different facets that are going to be going on and playing here in markets. Central banks are looking at a full week with Fed Chair Jay Powell testifying on Capitol Hill to the Senate and the House on Tuesday and Wednesday, respectively. On Wednesday, you've got the Bank of Canada meeting. They've been actually talking about possibly moving against the grain and not raising as quickly as people had previously been expecting. Do they continue that? And what are they signaling with the whole transitory or perhaps higher and hotter inflation? And then on Friday, this is going to be interesting. Haruki Kuroda, the governor of the Bank of Japan, this is his last Bank of Japan meeting. Does he deliver a surprise? Meanwhile, on the government front, President Biden will be releasing his budget for fiscal year 2024 on Thursday. This is going to be really important to get a sense of what his goals are, what he could potentially get accomplished, and then how that dovetails into the war in Germany. Well, he will be hosting European Commission President Ursula von der Leyen on Friday. And then, of course, on the data front, you get JOLTS, the job openings report on Wednesday, and the U.S. February jobs report on Friday. That's going to be really key, John, especially with a data-dependent Fed. We all know that the February jobs report completely changed the narrative. If we get some sort of feeling that wasn't a one-off, how much does that increase the rate hiking expectations in markets?
And what's so important here, John, buried in the week's data is the household change in net worth. This is not a small item. It's the hottest America right now. So many people struggling. The inflation's tangible. We start the week with a VIX at 19.06. House prices won't come down. I believe we've observed that. It's a generalization. And I really wonder what the state of the wealth of the haves is going to be.
I'm told we've missed the story. Manchester United. Do you want to squeeze that in? I wanted to make today a safe place for Manchester United fans after the result over the weekend.
I think they're vulnerable.
Should we stick to that? Just a safe place. Make it a safe place for them.
Okay.
Just a place that they can come to, a sanctuary, if you will.
Who are you?
And avoid the football school over the weekend.
What happened to you this weekend?
I turned it on. We're all Formula One, and we're honored that Christian Horner will join us here later. And John, I turned it on. It was 0-0. It was a good match. I turned it off. Boom.
Came back in the second half and bang. It's a safe place, a sanctuary here on Bloomberg Surveillance for Manchester United fans. Laurie Calvasina joins us now, head of US equity strategy at RBC Capital Markets. Laurie, I want to start with a line from a peer of yours, Stuart Kaiser over at Citi. He said, we remain in the camp that good growth is good for stocks. Laurie, is good growth good for stocks?
Well, look, I think that it depends on exactly when it comes. I think that markets are trying to sort of, frankly, start ignoring 2023. I think people are ready to get past it. And if you look to 2024, valuations look reasonable. So I think investors do want a sense that even if we get a little bit of a recession here, it's not going to be that bad. But I think we're increasingly getting closer to that point where investors want to make the case that we can start to play the recovery in 2024. So I think I'd probably agree with Stuart on that.
If we have inflation extend, Laurie, what does it do to revenues? What does it do to nominal GDP and to revenues? To me, that's the heart of the stability and even the lift that we see in equities.
It's a great question, Tom. And, I think inflation is complicated when it comes to the U.S. equity market outlook. In my modeling, what I find is that CPI actually has a higher correlation with S&P 500 revenues than GDP. So we know that if inflation stays a little bit elevated, it's going to boost those revenue numbers. There are, however, knock-on effects potentially on margins, but there is also another complicating factor there with pricing power as well. So, if you want to keep your pricing power, you need to keep a little bit of inflation. But I think where the big offset is on the valuation multiple. So if we have higher inflation, it keeps your revenues elevated, but it depresses your multiple.
It depresses the multiple, but then what do multiples do through the year? If we're vigilant, if we're stable, dare I say we even appreciate in value, how does the classic price to earnings or price to free cash flow multiple move?
So we've done some work, and I would say it's somewhat controversial. I don't know why it's so controversial because it's just math. But if you go back to the 60s, and we have some good data looking at PE multiples going back to the 60s, and we've built a little model that says if you plug in X, Y, and Z on inflation and interest rates, here's what your PE should be at the end of the year on a trailing 4Q basis. And we look at inflation rates, we look at 10-year yields, and we look at Fed funds. And if we bring inflation down to about 3% using PCE and core PCE, have something, say, around 3.5% on the 10-year Treasury yield, which is still where the ECFC forecast is on Bloomberg. And if I think we baked in recently 5.05 on Fed funds. So, having, optimism for a little bit of easing in the final part of the year at least, but still pretty high relative to where expectations were. We think you can get above a 21 times multiple, which should give us, some lift in equity prices this year. And when we do the math, we basically come up with the idea that you could even be above our 4,100 price target, say in the 4,300, 4,400 range. I don't know why this is so controversial. It's something I feel like I've been talking about since last summer at length, nonstop. But that's simply what the math shows. We just need a little bit of moderation in inflation, a little bit of easing on the 10-year, and the model is much more sensitive to those than it is the Fed funds rate itself, which is what I think probably really blows people's minds.
It's controversial because people think that something has to happen in the economy that has to play out in equity valuations in order for inflation to get down to that level. Are you saying that that's not true, that you're seeing this sort of disinflationary forces from the corporate earnings, from economic signals that give you confidence that you're right, that we could see ongoing momentum in some of these earnings without huge layoffs and just sort of a natural disinflationary process?
Well, what's funny, Lisa, is that when we bake in the earnings number here, we've got about 199. And so we're actually pretty far below the consensus. And we may actually end up being a little bit too cautious on our number, but our 199 number is baking in that moderation in inflation, which is depressing revenues, and is baking in, not a fantastic economy, but not necessarily a terrible one either. So we think we've got, sort of the right call here. And our numbers may be off a little bit here and there, but the idea that the economy can get hit, not too badly, but get hit in line with the consensus expectations, and inflation and rates, can stay above, kind of where they've been, but just come in a little bit and continue that path to coming down. We think that, and of course, sort of bake in a higher Fed rate. We think that it's enough. And I think what really confounds some of my peers is they think that multiples didn't fall enough to begin with. And we actually completely disagree with this, because if you look at where the markets were at the October lows last year, it's where my model, pretty close to where my model said you should have ended up at the end of last year based on the 222 earnings. So I think that's a key difference, is we think multiples already fell enough, and it's time that we can start seeing some of that recovery, as opposed to a lot of people who think we still didn't see a trough multiple yet. And I think that's a big difference.
Laurie, just the perfect guest to kick off the trading week. Thanks for being with us. Laurie Calvasina there of RBC Capital Markets. Looking ahead to Chairman Powell, 2 days to testimony on Capitol Hill, going into payrolls on Friday. Lisa's asked the question, Tom has, I have, we all have. Will the February data confirm the boom of January? Mislav Matejka over at JP Morgan with this to say to kick off the week. Our core view is that the current activity upswing is unlikely to develop into a fully fledged acceleration in the second half. For that reason, Tom, ultimately, they advise their clients to use the Q1 strength in order to reduce exposure.
Yeah, these are the opinions that are out there. I saw about 14 opinions this week, and from 13 notes.
Saw 10 alone this morning.
The one John Stolfus just published moments ago, and the one word I'm seeing on Monday set up by the bulls is not so much bullish optimism, et cetera, but this word resilient. And you can afford to be resilient if you sustain inflation and sustain nominal GDP. It helps out. It may not be constructive, but it helps out.
Speaking of the bulls, should we talk about Red Bull? Coming up in about, 20 minutes from now, Christian Horner, the team principal of Red Bull Racing in Formula One. TK dominance over the weekend.
It's going to be
from that
fun.
team to
I'm
kick
going to
off the
introduce
season.
it because I'm the dumbest guy in the room, and Mr. Farrow, who grew up next door to Horner, will lead the interview. All I can say, John, is we've never seen this, where sport and entertainment, film, have combined. Ever have we seen this.
And this sport finally breaking the United States of America in a major way.
Children have wonderful table manners. It's just extraordinary.
How have we pivoted to that?
He and Mrs. Horner have just beaten the children.
Is that a flavour of the interview still to come in 20 minutes?
That's my lead question.
Wait. Great tease. Christian Horner of Red Bull. Coming up, we hope.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China has set a modest growth target, suggesting that there will be less of a boost to an ailing world economy. Beijing's goal for gross domestic product growth this year is around 5%. Economists had expected a more ambitious target following a rebound in consumer spending and industrial output. U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the concerns is that TikTok gives China access to Americans' data. A second Norfolk Southern train derailment in Ohio has Congress calling for rail safety legislation. Saturday's derailment happened outside Springfield, Ohio. Now, that's about 180 miles west of East Palestine, where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned on Thursday when he testifies before a Senate committee. Now, negotiators have agreed on the wording of a landmark United Nations treaty designed to protect marine life in the ocean. If it's ratified, the treaty could build in new hurdles for corporations on the high seas. It does not regulate overfishing, which is managed by other organizations. And Credit Suisse has lost one of its biggest backers. Harris Associates stock picker David Harrow has sold the firm's entire stake in the embattled Swiss bank. Harris Associates was the biggest shareholder in Credit Suisse for many years, but by the end of last year, it held only a 5% stake. Shares of Credit Suisse had a record low last week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Exclusive today, J.P. Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond. Live from the J.P. Morgan Global High Yield and Leveraged Finance Conference in Miami. Only on Bloomberg TV and radio.
The growth may be pretty respectable. I think 5% is pretty good coming out of COVID. And it'd still be something of a growth engine for the global economy, but a knee-jerk reaction that they're going to go back and buy a ton of commodities, I think, is probably not right, and the markets are guessing that that's probably true.
Fantastic to hear from Michael Spence, the General Atlantic Spencer advisor on China's growth. A whole lot more than that. TK, I think you'd lead with the fact that he was a Nobel laureate, wouldn't you, Mr. Spence?
Spence is extraordinary. He reinvented graduate education in America. What he did at Stanford years ago now is just taken for granted but he was the first to restructure a master's degree in America to value.
Very cool.
Nobody talks about
and fantastic in the last hour to hear him talk about that new growth target out of China. Has a 5 handle, but that's where it ends.
Terrible.
It's 5%. And it's been described, and I say that this word should be in quotations, as disappointing. We'll see if it is disappointing. 5%. Is 5% disappointing to you, Lisa? 5% growth in China?
Some people are talking about the potential for a 6 or 7% increase just because of the sort of reopening trade. The question is this the high point? Is it only going lower from here? And what does it imply about the fiscal policies in China if it means that they're not necessarily going to prioritize hot growth?
I'm with you. That's the interesting piece of it. Another interesting piece of all of this, kind of below the radar, beneath the radar this morning, this reporting from the team here at Bloomberg. The Biden administration is nearing completion of an executive order that would restrict investments by U.S. companies in parts of the Chinese economy. Focused here on China tech. Tom, maybe look out for some headlines associated with that story a little bit later.
Yeah, the China tech issue is very tangible. It's very, very real. But, I love Ben Emmons had a quote earlier this morning. You know what? We're in love with our consumer products from China. And that's the end of it. What does the administration do? What do the Republicans and Democrats do to limit the stuff we love from China? The answer is they're not going to go there.
U.S. lawmakers are right now working on a bill to ban TikTok, and they're going to roll it out this week, and it's bipartisan.
That's not what I was thinking of. I was thinking of like cell phones and
I don't think the iPhones are part of this. This is stuff that helps China's military and intelligence capabilities.
This is very
now, whether
serious.
you would fold TikTok into that bracket,
the fact that
some people might.
The fact that they're examining every aspect. There was a story about cranes being built by China.
I saw that.
And the concern that could have secret spy equipment in there. I mean, China's saying that the U.S. is just paranoid at this point, but the fact that people are even examining this gives you a sense of the scope.
That sounds kind of paranoid, doesn't it, when you start thinking about cranes? And I've got no idea. Just when you start going there, it just sounds a little bit paranoid.
When I say that, it definitely does. But also, if we were talking about spy balloons, it also would sound a little bit paranoid.
But that's happening.
Oh, no, we're beyond spy balloons.
What are we on to now?
We're on to the mystery of 5%. Is that good or bad or whatever it is? Let's get some expert opinion on this. Enda Curran is encyclopedic on this. He's our chief Asia economics correspondent. And I want to go to the age-old solution, which is every cycle of China from 10 down to 8. We got to get back to 10. From 8 down to 6. We got to get back to 8 and on. They bail out the property sector. Over the weekend, did our Bloomberg News team discover that once again they're bailing out the property sector?
Well, there was some messaging in there about extra support for the property sector. Tom, there's no doubt that's on the way, but the big takeaway was this 5% growth target. Disappointed Wall Street because most analysts had come in around the 5.5% area. There seems to be some managing of expectations going on here by Beijing. They don't want the world to think they're going to go away again and unleash a major kind of debt-backed borrowing binge like they did in the past decade.
And it's so important here in all of your work here, and frankly, Steve Engel's work and the team. Can we parse 0.5 percentage point of guesstimate on China GDP? I would suggest that's foolish.
Well, I mean, I think in the point, I think the way a lot of people are looking at this, Tom, is that 5% is going to be a floor for China's economy, right? It's a target that they should hit pretty easily because of the pent-up demand post-COVID zero. Consumer sentiment's better. Business sentiment is better. We're already seeing that in the data. So 5% should be easy to hit. The second half of the year might be harder, and that's where, of course, the government will kick in with spending. But whether or not hitting how high it goes beyond 5%, or whether it's 5.5% or higher, I suppose, that's where you get into a very academic debate then about what its net contribution will be to global growth.
I know there's always been this tension, at least from outside analysts, about where the priority lies in China. Is it growth, as it was for decades, or is it some of the social and governance aims of Xi Jinping, including the data oversight, including trying to increase certain types of production in China and making more investments on that level? Is the 5% goal, or the 5% expectation in growth, a sign that the other aspects, the non-economic aspects, could take a high priority in the upcoming year?
I think tackling inequality has been a priority for Xi Jinping. I mean, it has been for previous administrations too. Common prosperity has been mentioned in past Chinese party documents. But no doubt, absolutely, Lisa, that side of the ledger is on his agenda. We had some comments from President Xi Jinping today, to your point. He was arguing that protecting the rice bowl has always been among his top priorities, but he also said as has been driving manufacturing development in China, forceful changes. He wants to push China to that next level of manufacturing development. I think that's where it's going to get very interesting over the years ahead. How can China pull that off? You know, in the go-go years, they could attract capital and people from Europe and US in the blink of an eye. But now you have these export restrictions coming on from the US, what seems like every other week or so. I think it's going to be very interesting to see if Xi Jinping can pull off that development agenda, which of course feeds through to what he can do for the broader standards of living for the rest of the population too.
What kind of retaliation do you expect from China, from Xi Jinping, to some of these measures by the U.S.?
It's difficult to say what they can do, really. I mean, we've had obviously the ongoing barbed rhetoric against the US, but it's hard to say if they can have the same. They can't strike back and hurt US firms in the same way that US can hurt Chinese development on these kind of issue. But it shows you how things have changed. And only a few months ago, we were talking about Janet Yellen heading to Beijing for talks that was supposed to get the economic relationship at least on a stable footing. Then, of course, we were expected to have the Secretary of State Blinken visit. That was supposed to get the political side of things back on track, but none of that's happening. And here we are now talking about export controls and whether or not China can retaliate.
Enda, thank you, sir. As always, Enda Curran there of Bloomberg on the latest over in Hong Kong, a 5% growth target from China's authorities. Lisa, I think the bulls, the major bulls, wanted this clean reopening, some fiscal stimulus in the mix, maybe kiss and make up between the United States and China. It's not going in that direction, just not yet.
If it was that, though, to your point, would that really be great for the bulls, right? Because you could potentially get a pop in oil prices and energy prices we just haven't seen yet. So on the flip side, does this reduce some of the inflation that you could see on the margins if there isn't that kind of growth?
I certainly don't think it would be good for the ECB. And Christine Lagarde, the ECB president, this is what we're hearing from the chief economist over at the European Central Bank, Philip Lane, wants more ECB rate hikes, but says policy can't be on autopilot. They're set to go 50 basis points at a meeting this month. It's going to be about whether they guide towards another 50 at the meeting after that. Philip Lane just moments ago, Tom, exactly what the ECB does in May will be very data dependent, and I guess we'll see.
I think we're going to see that across all central banks, including what we see here day after day, or including this morning, I might point out, as well. The data dependency has never been wider because the time is original. We have to, I can't emphasize enough, John, we are still coming out of pandemic debris.
Year 3.
Pandemic dynamics, and to use a normal analysis here is just not appropriate.
Although I will say this, I think the Governing Council at the ECB at the upcoming meeting will debate whether they should provide firm guidance to another 50 basis point hike at the following meeting.
They don't have forward guidance unless they do.
I know. It doesn't make sense, doesn't it? In the same meeting, they guide you towards the next one. They tell you that there's no
This is important. For those of you in America waking up now, 6:25 a.m., John has lived this in England, and I'm living it on the continent of Europe. Telephone calls about inflation.
Oh,
it's
yeah,
not like America. Plain and simple. It's different.
And the rate pass-through is different too. We've talked about that in the mortgage market. It's so much quicker in the UK.
There's a real question, and Andrew Sheets of Morgan Stanley brought this up over the weekend, about how much of the inflation in Europe is really stemming from and driven from the energy prices. And when you get the year-over-year comps, whether you could see more disinflation than people are currently pricing in. I don't know the answer.
I almost stayed in bed this morning.
Yeah,
The only reason I'm here, the only reason I'm here is because Christian Horner's joining us in 5 minutes' time from Red Bull Racing. That's it, TK.
I will mention Fernando. I won't mention Fernando.
You should mention Fernando.
No,
what an achievement.
I'll let you.
Very
You'll
cool.
do it with a British accent.
Christian Horner, coming up next.
Conventional thinking delivers conventional results. At Allspring, we break away with purpose. Harnessing data-driven insights and boundless curiosity. We dissect the market from every angle, helping to build portfolios that redefine what's possible. Because investing isn't one size fits all. Allspring, purposefully divergent.
This thing, it's making you get an ice bath again.
What do you mean? These straps are mind-blowing. They collect hundreds of data points like HRV and REM sleep, so you know all you need for recovery.
And you are?
I'm an investor in Invesco QQQ, a fund that gives me access to NASDAQ 100 innovations like wearable training optimization tech.
How long you...
I'm done.
Become an agent of innovation with Invesco QQQ.
I'm okay.
Before investing, carefully read and consider fund objectives, risk, charges, expenses, and more in prospectus at Invesco.com.
Lamita Feed is 101 years old. When COVID hit, we had some challenges. I heard about the payroll tax refund. It allowed us to keep the people that have been here taking care of us.
Learn more at getrefunds.com.
The first time you connected your website and your store was also the first time you realized
We can do anything. Cheesecake cookies?
The Chookie.
Manage all your sales from one place with a partner that always puts you first. GoDaddy, tools and support for every small business first.
Print, this is Lisa. Hi, I'd like 50 welcome wows and 300 customer I love it.
Promotional products from 4imprint are certain to deliver ooh yes.
Wow.
I love it. Find some wow now at 4imprint.com. 4imprint, for certain.
From tropical bites to cowboy delights, Nuts.com has over 1,400 delicious snacks to satisfy every craving. Enjoy every flavor of happy and get free shipping on your first order.
There's a reason big dental bills often come as a shock, because sometimes you don't realize what's not covered until you get the bill. That's why affordable dental insurance from Physicians Mutual is important. It can give you benefits that go beyond what you get from more limited coverage plans. Because no one likes a big dental bill, especially if you're retired or on a fixed income. For a free information kit, call or go online now. This isn't some discount plan or preventive-only coverage. This is real dental insurance that helps cover over 350 procedures, like cleanings, fillings, crowns, bridges, root canals, even dentures, at any dentist you want. Dental insurance from Physicians Mutual Insurance Company helps cover preventive care, basic work, and major procedures, with no deductibles and no annual maximum. For your free information kit with all the details, call now or visit sendinfokit.com.
Physicians Mutual, Physicians Mutual. The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Live from New York, big week ahead for equity markets worldwide with the Federal Reserve Chair Jay Powell on Capitol Hill a little bit later this week, going into payrolls on Friday. Can we build on a week of gains? The biggest weekly gain going back to January on the equity market. On the S&P 500 this morning, futures totally unchanged. On the NASDAQ, a lift by 1/10%. Confronting a bond market with a 4-handle on a 10-year last week, and we did okay, didn't we? We backed away since then on a 10-year yield right now, 390.88. Yields lower by about 4 basis points. And as the ECB chief economist Philip Lane talks up more rate hikes, your euro, Tom, looks a little something like this, 106.26 on euro dollar.
I think you're right on this to watch currency as we go through the week with all the different data. The 210 spread down to a new record low, negative 93 basis points. I'm not on the 100 basis point watch yet, but boy, we're getting there quickly.
7 years ago, if I tried to talk about Formula One on this program, Tom would have said,
Snooze.
What are you doing? What are you doing? Wait, Formula what? What's Formula One all about?
Exactly.
Back in 2015, the former F1 boss Bernie Ecclestone had this to say to ESPN. He said, we ought to try to break America, but it's hard for me because I'm not very enthusiastic about the country. It's difficult because they are sort of isolated. They are a big island, and they are slowly starting to learn about what other people in the world do. Well, Mr. Ecclestone was wrong. It seems the United States has learned quickly following the sale of Formula One to US-based Liberty Media, and with the help of Netflix's Drive to Survive series. Look at the TV audience here, Tom. Average race viewership in the US has gone from about 500,000 back in 2017.
Where was it yesterday?
To 1.2 million last year.
Where was it yesterday?
Probably bigger.
The fifth season.
Probably bigger.
This is a joy now. Christian Horner to join us, and of course, Mr. Farrell will lead this with legit knowledge on Formula One. But all I can say is what is so dominant here, and is it's a safe free zone for Manchester United this morning. Bloomberg surveillance is a safe free zone for everybody in Formula One that got their clocks cleaned yesterday.
Just ridiculous dominance, Tom. Absolutely. Christian Horner, the team principal of Red Bull Racing F1, joins us right now. Christian, congratulations on the win over the weekend. And let's start there. What goes into it over the winter to turn up in race one and absolutely dominate the way you did?
Well, first of all, thanks very much. I mean, it was a great start for us yesterday, and the regulations, they're constantly being tuned and evolving, but the basis of the car is similar to the 2022 reg. So the team have done a great job in evolving the car and evolving every single detail. Almost every component is new for this year, and with only 3 days of practicing, of testing, it was great to get that first big score in yesterday with a 1-2 finish.
Christian, we've all heard about the rule changes in the last 18 months. It was meant to make it more competitive. And I think a lot of people over the weekend might be looking at the front two and saying, what happened? What is it about this setup, these rule changes, that you think suits you and the team so well?
I think we've only run the cars at this track in Bahrain. We tested there and we raced there, and it certainly suited our car, incredibly well. But, the Formula One calendar is 23 different races, 23 different circuits, different asphalts, different conditions. And the big question is that kind of performance going to carry over into the different variants of circuits that we have? So it's going to take 2 or 3 races. I know a lot of people are saying, Red Bull are going to run away with it, but we're certainly not thinking like that, and we need to see a few more races to see how things pan out.
Christian, we started this conversation by talking about the changes we've seen in your sport, the attention it now gets from the rest of the world. Can you give us a flavour of that, just how maybe some of the nature and the size of the sponsorship deals have adapted, changed, increased over the last couple of years?
Well, look, we've seen massive growth. I think that the whole phenomenon through Drive to Survive has just introduced Formula One to a whole new audience, a younger audience, and very much an American audience. So I think out of the 25 new partners that we've introduced in the last 3 years, 21 of them are US-based, and 3 of them are in the Fortune 500. It's just, Formula One is on fire at the moment, and what Drive to Survive has done is it's done a great job of explaining the sport and bringing a new fan base in, a young fan base, a female fan base as well, and shown some of the characters and some of the competition that goes on behind the scenes. So it's a bit like, the Kardashians on wheels at times.
Christian, I'm sure that's selling in a big way. Does that work for you, Tom? The Kardashians on wheels?
I can see that,
is that
right?
what you're interested in?
I can see that on the side of Max's car. Kardashians
I'm
on
not sure
wheels.
Max would go with that. Christian, there are some hardcore fans, if you will, that are disappointed by some of the new tracks, including last year in Florida. Is there a risk that we sacrifice track and race quality for commercial and geographic expansion?
I don't think so. I think you've got to protect, the old circuits like the Monacos and the Silverstones and the Monzas. But then to bring in new circuits, I mean, we had Miami last year as a new venue. This year we got Las Vegas, and I have never seen hype around a race like that. I think it's going to be the biggest sporting event on the globe this year, and the demand for that race is off the charts. So of course, the commercial demand for the sport is at an all-time high with 23 races at 23 different venues around the world. So there's a mixture of street tracks and some of the old classic circuits. So I think it does cater for everything.
Christian, unlike some of the owners and the elites of Formula One, you've actually raced the cars. I'm fascinated what you think about the expansion to 4 more cars within Formula One. I know a $600 million buy-in is out there. To me, that seems low. But can the track take 4 more cars in that first dangerous turn?
I think that the tracks are certified to be able to take more cars. I think it boils down to the practicalities. You mentioned an entry criteria, and of course the commercials, like in any business, are going to drive the decision making on this. Effectively, you've got a 10 franchise set up at the moment that have their value through the exclusivity of those 10 franchises. And I think Liberty are keen to protect that as the custodians and the owner of the commercial rights holder. The FIA, the regulator, obviously they're looking to see, can more teams be accommodated? And so inevitably there'll need to be a compromise found at some point. But at the end of the day, it's going to come down to who pays for it.
Christian, you were talking about expanding to the U.S. and that things won't be sacrificed. But with the nature of the sponsors and the nature of the audience, which target audience are you going after? Is Formula One going after in the United States?
Well, we're bringing in a young audience, and we've signed up so many partners, recently, like Oracle and Hard Rock and Rocked and Cash App and so on. And of course, the big announcement for us last month was the announcement with Ford for 2026 on our powertrain. And we're looking to appeal to a younger demographic. Red Bull is an edgy team. We've got drivers that push the boundaries. We're a team that pushes the boundaries, and our following in the US is bigger than any other team. And I think it's only a matter of time in future years that an American driver will be running at the front in Formula One. And again, we want to be at the forefront of that. So we're looking to make sure that we protect the diehard fans, but that we attract a new audience, a younger audience, and a more diverse audience into the sport.
Christian, that's going to mean cheaper tickets, maybe. I was just looking at some of the prices in Vegas. It was cheaper for some of us on the East Coast, I think, just to fly to Europe, to go to Silverstone, Christian, than try and get a ticket at some of the tracks here in the United States. What can be done about that?
Well, look, I think it's supply and demand. And the demand for Vegas is just off the charts. Anybody that's anyone is going to be at that weekend. I think it's going to be the most watched sporting venue, as I say, of the year. But we do need to look after the fans. We need to have a sensible, entry price that fans can come and see a Grand Prix, can see these incredible cars. Because until you see it live, you can't comprehend the speed of these machines and what a human being is actually able to control around the streets, for example, of Las Vegas. So that's a responsibility that we as teams and the commercial rights holder have to protect and look after, the diehard fans.
Christian, you mentioned Ford. They're going to have a role in the speed of Red Bull racing in a few years' time. Can you just discuss the risks around a new relationship with a new partner and when the planning really begins?
Well, for 2026, it's new regulations for a new engine, and we as Red Bull decided to take on that challenge ourselves as an independent, as a subsidiary of an energy drinks manufacturer, taking on Mercedes and Ferrari and now Audi and Renault and so on. So we felt that it was right for us to align ourselves with a manufacturer to give us access to some of the R&D that they're investing, for example, in electrification. And discussing with Jim Farley from Ford and Bill Ford,